A warm good morning, everyone. I hope everyone is doing fine. And a special cheer for everyone who could reach on time in this rather chilly Pune morning. Thank you for being here. My name is Anandita, and today I'm honored to be hosting this seminar along with my fellow hosts. And I would like to extend my warm welcome to all the distinguished guests, speakers, faculty members, and our students. Thank you for being here. Before we continue, let's take a moment to recognize the legacy of the space we are in, the historic Kale Hall. This hall has hosted minds. This hall has hosted minds that change the way the world thinks. From Amartya Sen, John Robinson to Raghuram Rajan, this hall has truly seen it all. Not all hall remembers their geniuses, but this one surely does. And today, we add a small chapter to that legacy. We gather here for the National Seminar on Digital Lending in India, Innovation, Regulation, and the Road Ahead. An ecosystem evolving faster than our phones can update. Today, we explore how technology, regulation, data, and people evolve, evolve in a way. So let's begin because good questions, good conversation can change everything. To formally open today's proceedings, I invite a lady who wears many hats with grace. A research associate dean of academics and a researcher for 20 years, Dr. Atri Chakraborty. Let's please welcome her with a warm round of applause.
Thank you, Anindita. Good morning to all distinguished guests, respected speakers, industry leaders, all colleagues, and dear students. It is my privilege and honor to welcome you all to the National Seminar on Digital Lending in India, Innovation, Regulation, and Road Ahead. On behalf of Gokhale Institute of Politics and Economics, I extend a warm welcome to you. At the very outset, I would like to express our deep gratitude to Honorable Vice Chancellor, Professor Umakant Dash, for his visionary guidance and constant support. I would also like to thank Professor Rabi Narayan Mishra, Professor of RBI Chair Unit, as the seminar has been planned under his thoughtful, active leadership. The theme of the seminar, of course, is closely aligned with GIPE's long-standing research focus and vision on financial market, regulatory economics, and public policy. GIPE's strong academic ecosystem, which spans from 7 research centers, 10 PG and UG program, and of course the doctoral program, dedicates towards rigorous study of economics, finance, and public policy. I am delighted to have eminent experts with us who will guide us through this very relevant theme. And on behalf of Dean Academics Office of GIP, I look forward towards collaborative research, industry academia partnership. May today's dialogue pave the way towards innovation, experience learning, and inclusive transformation. I welcome you once again. Thank you.
Thank you so much, ma'am. To inaugurate today's seminar and guide us into the intellectual journey ahead, I now invite Professor Umakant Dash, our Vice Chancellor and an educationist of international repute and a human being par excellence. Let's welcome him with a huge round of applause.
A very good morning to one and all. Uh, at the outset, I would like to congratulate Professor Misra for organizing this particular conference on digital lending in India, innovation, regulation, and the road ahead. When we talk about digital lending, innovation, regulation, and roads ahead, of course, when you talk about the digital lending today stands at the intersection of technology, finance, regulation, and the consumers, the customers. It's reshaping how credit is created, accessed, delivered, and governed. So over the past few years, as already in the introduction told, we have witnessed a dramatic rise in the digital lending, digitally assisted lending models driven by smartphones and analytics. These developments have expanded access to credit, especially for individuals, micro entrepreneurs, and segments historically underserved by the formal financial system. However, the rapid growth of this digital lending also brings new challenges like anything else. Issues of transparency, ethical data management, algorithmic bias, predatory lending, and the need for robust consumer protection frameworks. It is therefore befitting that the theme today's seminar, we are talking about both the opportunities and responsibilities that accompany the sector's evolution. Innovations, of course, this is again can be considered the fuel for financial inclusion. This is what we have been emphasizing, and to become Vikasit Bharat by 2047. I think this is one of the building block. So India's digital ecosystem has created a fertile ground for innovations, which we have been experiencing for so many the last 2 decades. Fintechs, NBFCs, banks, and digital platforms have experimented with alternative credit scoring, embedded finance, co-lending partnership, and AI-driven underwriting. These innovations have helped unlock credit for the first-time borrowers and small enterprises who often lacked collateral and traditional credit histories. So digital lending, again, when we see, has also sparked new business models, which we have never heard of, like buy now, pay later. Peer-to-peer lending, platform-based lending, and sachet-size credit products. So these models demonstrate how technology can lower our transaction cost, speed up loan processing, and deliver credit to the remote areas. But innovation must be responsible. Trust is the bedrock of finance, because once the trust goes, the entire sector is going to fall. Regulation, of course, we have seen how the RBI is playing the major role in regulating the entire sector. Of course, we should not see the regulation as a constraint. They always come as an enabler, so that they take care of all the stakeholders in the ecosystem. When we talk about the regulations, you'll see the challenges remain are basically ensuring algorithmic transparency and fairness, governing AI ML driven underwriting, protecting consumer data without stifling innovation, crafting an optimal framework for bank, NBFC, fintech partnership. These are the questions that requires evidence, dialogue, and shared learning. Precisely that is what the purpose of today's gathering. Of course, when we talk about any sector, the role of academic institutions like GIPE cannot be underemphasized. So at this juncture, let me also highlight the importance of the academic institutions like Gokhale Institute of Politics Economics that must play in shaping the digital lending ecosystem. As Professor Atre has already spelled out, at Gokhale Institute of Politics Economics, we are deeply engaged in research on digital finance, financial inclusion, behavioral economics, because that is the very purpose and mission and vision of this institute, to undertake data-driven, evidence-driven research. So the rapidly evolving digital lending sector requires rigorous analysis, from credit scoring models to consumer protection, from algorithm fairness to the macroeconomic implication. GIPE brings together economists, data analytics, historians, sociologists who can undertake, a lot of practitioners and policy specialists who can undertake not only research and discourses which are going to help us in formulating various policies. So I think this is the platform which I can use to kind of give an open invitation to all the stakeholders from NBFCs, fintech companies, and other stakeholders to come collaborate and kind of partner with Gokhale Institute for joint research projects, policy studies, impact assessments, capacity building platforms, executive training and regulators, financial institutions, and fintech professionals. Through these partnerships, I think we can definitely co-create evidence-based, because that's again what we all lack in this particular macroeconomic setup, to help shape the policies that are both forward-looking and grounded in Indian realities. Because if we just depend on secondary data which are not related to the ground realities, or it always backfires. When we talk about the road ahead, of course, I must emphasize on 3 I's. The first was, of course, always we emphasize was on inclusiveness. If it does not help in narrowing down the financial inclusivity, it will not take off. The second one is about the integrity. And third is innovation. So these 3 I's are important even for digital market as well. When we talk about integrity, protecting borrowers, strengthening accountability, and promoting ethical use of data. Innovations, of course, which we are experiencing, enabling responsible experimentation while preserving systematic stability. So going forward, I guess we must invest in quality data, in secure data sharing framework, strong AI governance, financial literacy, and effective governance retrieval mechanism. So India now stands, of course, at a pivotal moment. When we are talking about the Vikasit Bharat to 2047, we want to be a developed economy. I think digital economy going to play a important role in achieving this particular target, which was set by our Honorable Prime Minister Modi ji. I am confident that the deliberations that today we are going to have are going to bring a lot of insight in reshaping, rebuilding, and making it a robust digital economic platform. At this stage, I think I would definitely also emphasize as a academic institution would need for strengthening the talent pipeline. When we say the talent pipeline, it is the young students. The Government of India, UGC, and other regulatory bodies, they are coming with innovative interventions, how these young students are going to be, say, picked up young, and they are going to be exposed to what is happening in the ecosystem or in the corporate world, so that they can learn while not only the textbook, but also they can gain experiences by working with the corporate people. One such initiative which the government has UGC has introduced of late was the apprenticeship program. So I think most of the academic institutions, they are developing programs, 4-year programs. Of the 4-year, 1 year will be spent in companies, right? So that it is a opportunity for both the organization as well as the academic institution. Organizations, you can observe them, you can make use of them, you can guide them, you can prepare the future workforce who are going to be not only efficient but also effective. As academic institutions, it's also going to benefit us because we can integrate the theory with practice. So the learning is going to be more effective, and it's a target oriented. So I request let us spend some time and explore and learn about these new initiatives which are being introduced by government of late, and see how we can take advantage of each other so that it is going to be a win-win proposition. I welcome you all once again to this wonderful campus. Gokhale Institute of Politics and Economics. If you get some time, please go around the campus. We have some historical places where we have the banyan tree. We still always look up to the banyan tree to get guidance, where Mahatma Gandhi got its kind of being taught about the ground reality about India by none other than Gokhale. And we have the Gokhale's Bangalore, where many people they visited the house, and many policies, many the future was reshaped. A kind of the India was what India should be and how India should look like. All those deliberations took place in those small halls. If you get a chance, please go around. And please interact with the students and research scholars so that you will be able to know what kind of ecosystem the Gokhale Institute provides. Thank you very much.
Thank you so much for your insightful words, sir. I personally have always loved listening to him. And now, to weave together the theme of today's seminar and help us anchor our thoughts better, I invite Dr. Rabi Narayan Mishra, RBI Chair Professor at our institute. He was the Executive Director, Supervisor in SupTech, and the Founder Director of College of Supervisors at the Reserve Bank of India. Please let's welcome him with a huge round of applause.
So, namaskar. Students, I didn't hear your namaskar back. Unless this ritual is done, I don't start my lecture. You know, namaskar. Yes. So, dear Vice Chancellor, dear professors and faculty, and most importantly, two other categories of listeners are also there. So, before I start, to set the theme for our panel discussions and keynote addresses. So I will just tell 2-3 things to elaborate what our dear Vice Chancellor elaborated. Here we have two types of learners. One T-1, so those are waiting, so they are behind, T-1. So T-1 are waiting to contribute their intellectual might to the industry to take India ahead. And we have T, and the delegates from various fintech organizations. And we have T+1 who will be speaking and giving their thoughts for the future on how to take India ahead by leveraging on the quality of technology we are known to be having. So this is the beginning of this kind of hybrid learner system, and all speakers who have taken a vow to give back to the society, because CEOs earn enough, they have enough knowledge and all. This is the time for them to give back the society to the T-1 people. So that is why in 2-3 things, so their intellectual collaboration is required. So one, so obviously faculty. So unless, because nowadays new generation is very knowledgeable in technology, but you should keep coming and meeting faculty, students, and tell what is required to be done in the future. So that important job also will come. Anyway, our Vice Chancellor will deliberate more on this during lunch time, so I will not go into that. Now let me come back to my real job of setting the theme in the context. And for the students and the personnel of the fintechs, so I will give an example of how you should write and speak. So that is why I have spent some time and designed that in that pattern. So digital lending is not a trend, it is a transformation. This is not the future, this is the now. So you should write like that. No sentence should be more than 4 words. Speed, scale, and simplicity. This delivers all the 3 at a time. India is not adapting, India is leading. Fintech are making this happen. So I personally appreciate the effort of the fintech CEOs who were either bankers or academicians and had the moral guts to create their own institutions, to create wealth for the country. So you are the real contributor to wealth in Indian economy. So these students at least should clap for them. So fintechs are rewriting the rules of credit, coming to lending. No branches, no paperwork, just possibilities. India's fintech sector is booming. Over 2,000 startups are reshaping finance. Digital lending alone is projected to hit 9 trillion rupees by 2030. They are bridging a $1 trillion credit gap for medium and small enterprises. That is now the focus which will take India towards Vikasit Bharat. Without this, in India, you cannot rise. They are reaching the unreached. They are making credit inclusive, as our dear Vice Chancellor told already. That is the definition and the professed ambition and vision of fintechs. This is what we call in economics creative destruction in action. Old systems have fallen. New ones like fintech have risen. Traditional banks relied on paperwork. Fintechs rely on algorithms. Credit scores were gatekeepers. Now, alternative data opens the door. Loan officers are being replaced by artificial intelligence. Underwriting is now automated. This is not just disruption. This is a renewal through replacement. But there is a flip side. Innovation has a shadow. It is called destructive creation. So this is my contribution to the literature. That creative destruction will eventually give rise to a scenario called destructive creation. Exactly opposite. Schumpeter had told creative destruction. So now new generation students will define what is destructive creation. When progress creates harm, we must pause and reflect. Easy loans can lead to over-indebtedness. Aggressive recovery can cause distress. Data can empower, but it can also exploit. Unregulated platforms can create chaos. Privacy breaches can erode trust. So yes, digital lending is creative destruction, but it can also be destructive creation. And for that, regulation from Reserve Bank is already there. So my younger brother, Vaibhav is already there. He will talk about their vision and all. Okay, so they will do that. Why students should learn this early? That is also an issue for the students, also for the practitioners. For future ready skills, better career opportunities. Understanding digital lending equips students with knowledge of AI, data analytics, and financial modeling, skills that are in high demand. For policy awareness, entrepreneurial mindset. Learning now as digital lending learning how digital lending disrupts traditional finance and how it can inspire students to build startups. Because nowadays younger generation, they don't want to be naukars. They want to be employers. Hare, you come, welcome to Gokhale Institute. So anyway, when he comes, I will tell little about him. For students, this is gold. Fintech fluency is financial literacy. Fintech fluency is financial literacy. So final thoughts, so that we will start our job. Digital lending is India's moment. It is just not an innovation which we should only celebrate. Let us make it inclusive. Let's make it ethical. Let's make it unstoppable. Let us not just build fast. Let's build fair. Thank you very much. Namaste.
Thank you so much for a compelling start. And now, let's carry that momentum straight into our first keynote, one that examines digital lending from the lens that matters the most: regulations. We are honored to invite Mr. Vaibhav Chaturvedi, who is the Chief General Manager of the Department of Regulations at RBI. He's a central banker with over 25 years of experience across some of RBI's most critical regulatory and supervisory roles. He currently leads credit risk regulation and serves on major policy committees, including the Insolvency and Bankruptcy Board of India, and also plays a key role in shaping India's regulatory landscape. Academically, he brings global perspective through his advanced degrees from Columbia University and the National University of Singapore. Ladies and gentlemen, please join me in welcoming Mr. Vaibhav Chaturvedi for the keynote address. May I please request Mr. Ashish Goel, co-founder Fibe, to felicitate sir with a bouquet of flowers.
Very good morning to you all. Professor Dash, Vice Chancellor, Ravi Mishra sir, the RBI Chair Professor, Dr. Chakrabarti, Associate Dean, the faculty of the Gokhale Institute, the distinguished guests, and the students. It's a privilege to be invited to one of the oldest and most prestigious research institutes in economics with a rich history which is tied to the freedom struggle and early nation building efforts. I commend the RBI Chair Unit, Gokhale Institute, for organizing this seminar. The title, Innovation, Regulation and the Road Ahead, it aptly captures the nascent evolutionary journey of this digital lending space in the country and the dialectic interplay between innovation and regulation. I have been invited here today in my capacity as a regulator, and staying true to that role in my remarks today, I intend to share my perspectives on some of the evolving aspects of this interplay. The speakers before me have laid out a huge promise which the whole recent innovations, the digital lending, the fintech space, they hold for taking India to the next stage of development. But and they have also rightly pointed out the other side of this whole process, which is equally important to keep things on rail. So regulation, by its very nature, is kind of reactive. It responds to the evolving situation, emerging trends, and if required, putting in place some principles and rules to put some guardrails around it. It's not an enviable task, I can tell you, not a perfect science. It invariably involves judgment, and there might be occasions where you might err on either of the sides. So, but that comes with the part of the job. Many in this room might possibly harbor some disagreement with some of the regulatory actions which RBI has taken, but this disagreement, I am sure, would be with the nuances, not the process or the fundamental principles or the broader outcome. To set the tone, I can do no better than quote from the latest speech of RBI Governor, which was delivered yesterday on regulation, where he beautifully explains the why regulation of the financial sector is different from the regulation of any other sector. Because that question is normally asked, that why is financial sector so tightly regulated unlike other sectors? So he mentions three factors which are critical here. One, the interconnectedness of the financial system, which means that if one problem with one institution can affect the entire system and which can have huge costs. Second, the inherent vulnerability of banks due to their liquidity transformation role. So that's the inherent in the business model of the banks. this maturity, liquidity transformation, and that exposes them to that element of risk. And third, the potential economic costs arising from the pro-cyclicality of credit. There are booms and busts, there are cycles, and we have seen so many times in the past, in our own lifetimes, globally, when the cycles have turned and the kind of huge costs they have imposed on not just one economy, but the global economies. So in this backdrop, let me turn to the evolution of regulatory thinking and approach, specifically with regard to digital lending space in India. We are witnessing technology reshape how credit is discovered, priced, delivered, repaid, and we have seen the kind of revolution which has happened over the past few years. Digital platforms have made it possible for either to exclude segments, like an artisan, a small town, a street side shopkeeper, a fledgling entrepreneur, to access credit in a matter of minutes, kind of commoditized credit. So, and that is the promise it holds, and the promise which everybody talked about. But as history teaches us, speed and scale without guardrails can also create hazards which become costly to unwind. Though digital lending has improved access and speed of credit, it has also brought along with it share of risks, such as fairness in pricing, the interests of the borrowers, and other business conduct issues. RBI's response has been calibrated, focused on improving transparency, accountability, and grievance redressal. The aim is to enable innovations in expanding access and ease of transaction brought about by digital channels, especially for underserved segments, while embedding safeguards so that growth remains both sustainable and fair. That objective shaped the initial instructions which were issued by RBI in 2022 on digital lending, which kind of lay down the the framework, so to say, to regulate the whole space. Because till then, we had been seeing a lot of innovations had started happening, and a lot of practices had also started emerging in the sector, both good and bad. So there was need to put some structure to that, so that the promise which the sector holds is not lost. So that was the first time we came out with those guidelines, which were designed to translate accountability into practice through a set of interlocking measures that promote transparency, contestability, and fair treatment. So just quickly, I'll recap some of the key principles which the directions enshrine. It's important to recall because that kind of underlines the whole regulatory approach of RBI towards this fledgling space. First, the principle was the flow of funds between lenders and borrowers must occur only through the borrowers and lenders' bank accounts without any third-party involvement. The others can be facilitators, but the fund flow has to happen between the lenders and the borrowers' bank accounts. This simple rule, it reduces the avenues for fraudulent diversion of funds and makes payment flow auditable. Second, the new category which was recognized, which was the lending service provider, which to facilitate this function, they must not collect fees or charges directly from the customers. Any charges levied by the lender must be upfront, disclosed transparently in the key fact statement which was to be given to the customer. This prevents circumvention of consumer protection by pushing hidden charges through third parties. Third, as I mentioned, borrowers must receive clear, comparable information at the point of loan offer in the form of a key fact statement. The objective is straightforward: enable apples to apples comparison so that borrowers can make an informed decision. So the important point here is it's just mere provision or disclosure of information is not sufficient. You have to enable the user of that information to compare or use that information in a meaningful way. And that is what KFS does. It standardizes what everybody has to give it to you so that you can compare. Fourth, and that's important, is data collection must be purpose limited, need and consent based with robust audit trails. Obviously, use of such data comes with privacy risk and may raise the possibility of discriminatory outcomes. And finally, we recognized, recognizing the innovation, and which was already happening in the space, was to allow a limited default loss guarantees. So basically, that's nothing but it's a lender who gives credit or lends to a borrower based on somebody else's guarantee. That if that person defaults, there is somebody else to kind of who stands behind that. So that holds a lot of promise, but again, it has some issues because some risks for the lender, because it can dilute the underwriting standards, the lending, and that we had seen, some of you would have studied the global financial crisis in 2008. That was one of the issues with this whole argument about distribution of risks, that there are, when the risk gets distributed, nobody knows where the risk resides. And the person who is at the front, because he's not, he'll not be on the hook when the person, when the default happens, the underwriting standards, they get diluted. So that is the concern, where we didn't want to totally open up this provision, but in a limited way, up to 5%, we have allowed the LSPs to provide the default loss guarantee to the lenders to ensure their skin in the game. So one of the recent changes that we have made to the guidelines, again as part of a responsive approach, was that in many cases it was observed that where multiple REs have been onboarded by the LSPs, and the decision of matching the borrowers with that lender, that rests, what we saw as a practice, that rests with the LSP, not with the borrower, which is how it should be. So now we have kind of corrected that and said that, okay, even if you have arrangements with multiple lenders, when you are on your app, when you are showing all the offers to the borrower, first show everything to the borrower, all the offers available, and then the final decision has to rest with the borrower. So that change has been brought about. So these aspects highlight how the guidelines are designed to be adaptable, customer-centric, and flexible rather than overly prescriptive unless situation warrants. This approach gives regulated entities room to innovate while still upholding the core objectives of protecting consumers and ensuring the integrity of digital lending, the issues which were highlighted by both the Vice Chancellor and Dr. Mishra. Now, as we look ahead, we recognize that innovation in credit delivery will not stand still. Tech-driven innovations will continue to emerge. While the early phases of digital lending were marked by innovations in sourcing, onboarding, and underwriting, we are now seeing a new wave of applications in areas such as customer serving and recovery. The digital lending ecosystem has also evolved significantly to include a wide range of actors, the banks, NBFCs, and a plethora of fintech platforms engaged in a variety of activities. Two realities make this complex. First, many participants are hybrid, so the boundaries are getting blurred. A payment app may also originate a loan through an NBFC partner. A merchant may both sell and finance goods. So the responsibilities and duties are, it's difficult to now segregate. So that's a challenge, that how do you approach it from a regulatory point of view. Second, finance is getting embedded. The credit is being offered at checkouts, inside apps, on ledgers, within commerce workflows. So this embedding increases convenience, but it also blurs the boundaries of responsibility. So RBI is closely observing these developments through the same lens that has guided our approach so far. Every innovation must preserve borrower's choice, uphold transparency, and ensure that access to credit does not come at the cost of fairness, trust, or overall systemic stability. Let me focus on a few of these issues that we are seeing, some of these emergent issues. First, I think it was briefly talked about in the morning, was the use of automated or model-based credit underwriting. So one of the enablers of rise in digital lending is the use of algorithmic models involving AI ML on the vast digital footprint being created by individuals and companies. Usage of algorithmic tools for credit underwriting promotes efficiency, as evidenced from several studies, which have found substantial gains in terms of predictiveness and cost savings for lenders from using machine learning models relative to conventional models. Use of these tools has also promoted credit flow to credit-starved sectors. However, such underwriting models can introduce risks due to data biases and deficiencies in model development. Biases in training data may lead to model outcomes which are different from the real world outcomes. Historical data can reflect historical biases, potentially creating models that discriminate against certain class of people, and that's a real worry people have started talking about internationally. Given that some AI/ML models may be designed to adapt and learn from incoming data, it makes them susceptible to issues of data drift and concept drift, which in turn makes these models less stable. Now, this potential for drift, when combined with lack of explainability, could lead to lenders' management failing to understand the results and keep trusting the model when that may not be the right thing to do. Now, this can lead to a range of prudential risks as well. So the lenders need to be cognizant of these risks while deploying the underwriting models and should have the independent external validation in place. It must be kept in mind that while algorithms can provide valuable insights and efficiency, they should be viewed as tools to support, not replace human judgment. And this issue about the model risks, which we call this whole type of risk, it's not just limited to digital lending. It runs across the entire the financial system in all activities which the financial entities do. And we had RBI had come out with the draft framework on model risk management, which kind of enshrines some of the broad governance level frameworks, because ultimately these things will have to be internalized. There will have to be governance frameworks put in place by the entities themselves, the strong processes put in place so that these things are taken care of. Because just relying on ex post outcomes may not be the option anymore. Second issue I'll talk about is data protection and privacy and sharing. So there's an old age-old parable of the blind man and the elephant, where each man feeling only part of the animal draws a different conclusion, and none of them can see the whole elephant. In many ways, the financial services sector, it faces a similar challenge. Each institution holds a fragment of the customer's data, making it difficult to form a complete picture. Gradually, some of these pieces have started to fit in place and come together. Again, let's see, I'll highlight the role of RBI there, because RBI has kind of proactively enabled some of these aggregation mechanisms. One is through the account aggregator framework, which you are aware, it's brought that into a regulated space. It licensed account aggregators, and now every data, financial data, goes through the account aggregators, which can be used and which is being used by these fintech lenders to make their credit decisions. The recent initiative was the Unified Lending Interface, which was developed by the RBI Innovation Hub, which brings certain non-financial data also along with the financial sector on one platform. Now, that again is a huge promise potentially, because what it ultimately does is it will be a super repository of all kinds of data which we have in the system. We have account aggregators on the one side, you have your non-financial data on the other side, your phone bill records, your electricity bill payment records, all kind of credit history. And when everything comes into place, it can be a kind of a very potential combination to kind of give a fillip to this revolution. However, alongside these developments, we are also witnessing growing concerns around fair usage of customer data. Some REs and fintech seek data access beyond what is reasonably required for their stated purpose. With the introduction of the RBI framework, which I talked about, as well as the Digital Personal Data Protection Act 2023, the focus has decisively shifted to data protection, privacy, and explicit consent. Any collection or sharing of data must now be transparent, purpose-specific, based on the informed consent of the customer, and deviation could invite serious regulatory consequences. The government has recently notified the DPDP rules as well, which were widely awaited, which formally operationalizes the Act. So while the rules don't introduce new substantive obligations beyond the Act, they specify the timelines and procedural requirements for achieving full compliance. The DPDP framework establishes practical consent-centric obligations for all entities handling digital personal data, including purpose limitation, data minimization, easy withdrawal of consent, mandatory breach reporting, and stronger rights for individuals. For digital lenders, this affects how loan apps collect alternative data and use automated profiling for credit decisions. They significantly raise the enforcement stakes through enhanced security expectations, documentation requirements, and stringent penalties. So as a result, entities will need to revisit their data flows, third-party contracts, and the incident response protocols. Next, coming to again the important point which was raised by Professor Dash, was responsible lending. The facilitation of easy credit, which one can also say a supply push credit, it very easily can translate into extending credit to customers for purchasing goods and services, even in cases where they don't need these or they are not capable of repaying it. Dean ma'am had spoken in the morning about training the students in psychology and all. So this is the heart of where the interface of psychology and finance, and there are kind of people have won Nobel prizes for studying this, that how the policies can really nudge consumer behavior, where you are not conscious of what how your decisions are made, because ultimately human being is irrational, and where that irrationality comes from is what the psychology brings. So again, I mean, so that's a kind of a concern. So many e-commerce platforms and lenders, in their pursuit of maximized transactions, often exacerbate the issue by opting for credit as the primary payment option. Now, the consequences of this are far-reaching. Firstly, it encourages consumers to overlook alternative payment methods, leading them to avail credit unnecessarily. This not only exposes them to risks of accumulating interest and fees, but also normalizes the habit of relying on credit, even when it may not be in the best financial interest. Moreover, the ease with which the consumers can access credit during purchasing process can result in disconnect between the perceived and actual cost of a product. This lack of transparency can contribute to overspending, as consumers may underestimate the financial impact of their choices when using credit. Must be kept in mind that trust is the cornerstone of financial services. Without it, people are less likely to save, invest, or borrow, and those behaviors underpin economic growth. And legitimacy obviously doesn't come automatically. It must be earned through transparency, accountable governance, and consistent protection of customers. So thus, it is imperative for all to take proactive responsibility in ensuring that their digital interfaces are transparent, fair, and free from any form of dark patterns which unconsciously lead people to certain decisions. They should undertake regular audits of their user interfaces and customer journeys to identify and eliminate any design elements, no matter how subtle, that could mislead or nudge borrowers into availing products they don't fully understand or need. Equally important is the promotion of financial literacy among users, enabling borrowers to make informed choices about credit and other financial services. By embedding ethical design principles and empowering consumers with knowledge, the lenders can build lasting trust, ensure responsible lending, and contribute to sustainable growth of this space. Niche business strategies is one more issue which we have been some issues have come up, that some challenges there, which often innovative and efficient during periods of growth can introduce considerable fragility into the system, because they can increase the dependency on a particular sector, a particular model, and then when that sector gets impacted, then the entire model really goes for a toss. So the example which I think everybody would be would appreciate is this whole microfinance thing, the way things have gone. There was a period when there was a boom in that whole microfinance lending, where everybody was targeting that, and there were entities specializing only in that segment. But as happens with all credit cycles, when some stress started building up, it obviously started impacting the balance sheets of the lenders also. So it's critical that the need for these lenders to have the robust strategic systems in place, the business models in place, and also important to adopt robust forward-looking macroeconomic models and assumptions when estimating their expected credit loss provisions, so that when the downturn materializes, the assumptions underlying ECL still holds and significant provisioning buffers exist to absorb the losses. So thus it's essential that specialization in lending, accompanied by sound governance, prudent risk management, and a strong culture of internal control is upheld. And stress testing must be rigorous and comprehensive, and adequate capital and liquidity buffers must be maintained to absorb the shocks. Lastly, coming to a very kind of a critical issue for everybody is issue that affects us all, and we collectively need to find an urgent solution. It's the scourge of illegal apps. It's not just a financial crime issue, it's a humanitarian crisis driven by a sophisticated, often cross-border infrastructure. This is a huge challenge spanning across agencies, including law enforcement. But I must mention about a recent initiative taken by RBI in this regard. RBI has operationalized the public directory of digital lending apps for the limited purpose of aiding the customers in verifying the claim of a digital lending apps association with the RE. So basically the idea there is that all the REs, the banks and the NBFCs, when they are deploying either their own lending apps or the laps of a lending service provider or third-party apps, then they have to come and report all those apps with the details on this repository, which is available publicly for everybody. So as of today, there are more than 600 unique DLAs which have been populated on this portal by around 240 lenders. So how and whom it helps? So one is, as I said, the consumers, anybody who receives an offer on the mobile for a loan from some random app, you can go and check on this website whether this app is actually authorized and associated with either a bank or an NBFC. And second, going forward, and which will be kind of a more biting in one sense, could be that these Play Stores who host these apps, they can start cross-checking when they do their due diligence for onboarding those apps. This could be part of their due diligence, that whether this app is actually associated with a regulated entity or not. And if not, they can stop onboarding that app right away. They can nip the problem in the bud. So so this could help. But the only caveat there is that this is reported just on an as-is basis. There is no validation done by anybody. RBI doesn't kind of undertake any validation. It's what the bank or the NBFC is claiming that this is our app. Okay, then you report it. That's all. So it's only a directory, nothing more than that. To conclude, to ensure that the digital lending ecosystem grows sustainably, it's essential for all stakeholders to play their part. Obviously, the players, the lenders, the LSPs, they are the most important stakeholders in this. Sound practices and operations capable of handling the issues raised earlier, and the well-recognized trade-offs and deployment of technology for credit are a sine qua non for success. SROs, the self-regulatory organizations phase is here, play a pivotal role in shaping this whole digital lending ecosystem. They have to serve as an effective bridge between the regulator and the industry. SROs must enforce self-regulation on critical conduct aspects such as responsible advertising, ethical collections, data handling practices, etc., and act as the industry's first line of defense. Equally importantly, they should nudge members to adopt prudent customer-centric standards that go beyond procedural compliance to embedding fairness, transparency, and accountability into everyday operations. As far as RBI is concerned, our regulatory vision for digital lending is straightforward but ambitious: to enable broad, affordable access to credit while ensuring that technology serves and never subverts the interests of the borrower. We'll pursue a proportionate, technology-neutral framework grounded in 4 complementary pillars: consumer protection, market integrity, accountability, and a guarded space for responsible innovation. At the same time, we'll support innovation and never business models. This is not a choice between protection and progress. It's a commitment to design a market where speed, scale, and innovation coexist with fairness, transparency, and accountability. And the directions we have issued are not the end point. They are a framework for continuous engagement between the regulator, the industry, and the civil society. We'll monitor outcomes, learn from experience, and refine our approach as required. But the principles will remain the same. I'm sure many of these issues will get deliberated in greater detail in today's deliberations in this seminar, and I see a stellar array of panelists and speakers ahead of me. I wish the seminar a great success. Thank you.
Hello. Yeah. Thank you so much, sir, for such an insightful session on regulatory sphere. May I now request Mr. Ashish Goyal to present Mr. Chaturvedi with a memento? Thank you. I would also like to extend gratitude to the press members present over here for covering such an important digital event. Thank you, everyone. Moving on, we'll now begin with our first panel discussion of the day, which looks at how large financial institutions approach digital innovation and what that means for the future of lending in India. I would kindly request all the panelists to occupy their seats on the stage. Let's welcome them with a round of applause. I would now request our student, Ms. Nupur Singh, to present bouquets to Mr. Ashish Goyal. May I now request her to present a bouquet to Mr. Sandeep Ubale. May I now request her to present a bouquet to Mr. Siddharth Mishra. May I now request her to present the bouquet to Mr. Anjani Rathore. And may I now request to present the bouquet to Mr. Ramaswamy Iyer. Thank you. Now let me introduce you to the panel. Our moderator, Mr. Ashish Goyal, co-founder and whole-time director at Fibe, is the financial strategist behind one of India's fastest growing fintech institutions, a chartered accountant and former chief investment officer at Bajaj Alliance. He has played a central role in founding and scaling Fibe while maintaining strong risk, compliance, and governance standards. Our panelists today represent the digital backbone of Indian banking. Mr. Sandeep Ubale, Chief General Manager and Deputy Chief Digital Officer at State Bank of India, has over 35 years of experience and was one of the key contributors to SBI's flagship digital platform, YONO. He currently oversees analytics, CRM, digital marketing, YONO Business, YONO Global, and the trade finance revamp. Our next panelist, Mr. Anjani Rathore, Group Head for Digital and Customer Experience at HDFC Bank, is an alumnus of IIT Kharagpur and IIM Calcutta. He has been instrumental in driving digital adoption, customer experience, data strategy, and process excellence across the bank. Mr. Siddharth Mishra, who heads digital channels, partnerships, customer service, and the NRI and International Financial Institution Group at ICICI Bank, has spent 27 years with the institution. He previously led a retail franchise of over 1,800 branches and 30,000 employees, and has played a major role in shaping ICICI Bank's omni-channel digital ecosystem. Mr. Ramaswamy Iyer, founder and CEO of Vaina, is an IIM Ahmedabad graduate and a seasoned entrepreneur in trade finance and cash management. He's built Vaina into one of India's leading MSME-focused supply chain financing platforms. With that, I'll hand it over to Mr. Goel to guide the conversation.
Thank you very much. Ladies and gentlemen, welcome all of you to the National Seminar on the Digital Lending in India. In last 10 years, the digital lending in India has really come a long way. In 2015, when many of the fintechs started, it was just a buzzword. Today, really at every place we hear digital lending is the key piece. And digital lending is just not done by the fintechs or the other digital lenders. It has been quite evolved by the banks. They are running the forefront into that space. It is my pleasure to moderate this session today, which is on the innovation at the large scale. Whenever we think about digital lending, fintechs always comes into mind, but rightly so, because they have done a lot of innovations in the AI startups, fintech disrupting traditional lending, wealth management, etc. But let me mind you, in India, I feel the heat of fierce competition from the banks on a day-to-day basis. The large players in each segment has digitally evolved. They have done the innovations at a scale in a very, very agile way. And today I could not have been asked for a better speakers today. There are the three top innovators, SBI, ICICI and HDFC Bank, and also my dear friend Ram, who works his magic in the supply chain financing. The width and breadth of activities done by this institution is breathtaking. From Bharat to Metro, from deposits to loans to cards, managing government accounts, Forex, it's just mind-blowing activities the banks do across the spectrum, and the technology is today playing a big part. And with the new evaluation about where the AI is a buzzword, I'm pretty sure it's quite exciting and challenging for the roles which you are handling at your banks. Without further, I'll first my question is to Sandeep. SBI is the largest bank today, and at the scale of SBI, what does the innovation really means to you? Is it a tech, operating models, culture, and what is the recent initiative you can talk about which has really moved the needle? Because to move a needle at SBI, you really need to be a very big needle you need for that.
Yeah. Thank you, Ashish. First of all, thanks for giving this opportunity. GIPE being one of the most prominent and oldest research institute in India, it's an honor to be on this stage. Well, to reply to this, to your question, let us go back to year 99 or 2000. If you look at the evolvement of banking industry in the last 25 years, vis-a-vis the new technologies, the ATMs came, followed by internet banking, the core banking, which was implemented across PSUs. The new generation private sector banks, they came along with core banking and new technologies. And to match that, the PSBs also embraced all these new technologies. And then came mobile banking, etc., etc. So this Gen AI or AI, what we are talking about, and the adoption of this so-called innovative technologies has become part of the culture now. Okay. So at SBI, innovation is part of the, what I can say is part of our culture, practice, and business strategy. If you talk about the recent innovation in 2025 that we adopted, which has moved the needle, then two things I can talk about. One is adoption of Bhashini on our bank's website, bank.sbi, and on our customer-facing channels like Yono Business, and there is one more channel where it has been integrated with. So when we integrated it with bank.sbi, it facilitated customers across length and breadth of the country, covering all states, speaking different languages because we have a customer base pan India, including foreign countries. So now they are able to put their query in their own language and the reply comes in the language which they want. If you key in your query in English and want to get reply in vernacular language, then you are getting it. So that has made a big difference. Speaking about internal customers, which I believe are equally important, because unless the internal customer is sensitized about the innovation and gets the benefits of innovation, it may not be passed on to the external customers with the same intent and aggression. So for internal customers, what we did, we have a staff strength of around 230,000, which is quite huge. And now these people, when they attend to customers on day-to-day basis, whether they are sitting on the front, whether they are a frontline staff or working in the back office, banking being so complex and various lines of businesses being handled at the branch level or at the admin level, not many times the person who is handling a particular case is aware of the rules and regulations or the bank circulars for that particular matter. And then they used to key in their query in some very rudimentary kind of a chatbot. And then at the back end, there was a team of experts which used to read that query and go back, which used to be time consuming and not on real time basis. So we came out with generative AI powered chatbot by name Ask SBI, which covers more than 15,000 documents of around 150 plus departments. And the moment a query is keyed in by the user, the reply is given within millisecond. So that is one innovation which is helping us in a big way. So when you talk about the tech, operation and culture, innovation, like any change, requires change in managing all these three. So on the tech side, we have moved from the traditional technologies to the more recent technologies of Gen AI or real-time AI. On the cultural side, people are getting used to use Ask SBI kind of chatbots rather than calling someone or using the old-fashioned chatbots. And on the operation side, introducing all these models in the mainstream of the banking is something which required a shift in the operational management mindset, which has happened. So these are the things which have happened recently, and they have really moved the needle. And now wait for launch of Yono 2.
Okay.
That will be really a big game changer, which will happen most probably by the end of this year. So these are the things I would like to
I
talk
keep
about.
hearing,
Yeah.
is the, can be a fintech spun out of SBI to become a very large fintech entity. Just on a follow on, because this Bhashni is quite interesting. How's the impact of this Bhashni? Did the customer queries, customer reaching out to the SBI branches or to the call centers has reduced, or the customer satisfaction has gone up?
Yeah, we on average receive around 1 million queries.
A day?
Yeah, a day. Whether it is through contact center or through our bank website, or there are multiple touch points, all put together, I am saying. Okay. Since our customer base is quite high, 52 crores, so 1 million is something which is
Expected.
Which is expected, yeah. And since people are getting reply in their own language, the UX has gone up, definitely. The comfort and UX has definitely gone up. The most affected or benefited clientele are the clientele from the hinterlands, who would like to know about some government sponsored schemes. And in the past, a typical standard reply was given in English or something like that, or Hindi or something like that. But when you explain them in their own language, it definitely enhances their trust in the banking system and also gives them a lot of comfort. One more thing, this Ask SBI, what I was talking about for our internal customers, also gives replies in vernacular languages.
Okay.
So people who are working in, say, interior of
areas.
India may not be so familiar with either English many times also with Hindi. They will key in their query, whatever they have in mind, but the reply will be given in the language that they want. So it's making a lot of difference.
Maybe
Sure.
it itself can be a product for other banks on the processes and
yes.
on the RBI regulation, I'm pretty sure. Moving to Anjani, you are running at HDFC Bank, which is forefront in the technology space. I still remember in 2001 when I started my career, HDFC had a ATM, and when I came from a rural India, first time I saw the ATM machine. But today, fast forward 25 years, everything is instant. Some guilty to us, instant loans, instant deposits, and instant approvals, where the loan journey needs to become frictionless, and a lot of innovation is happening towards making credit accessible in seconds, if not in minutes. How do you really think of designing the journeys, designing the customer experiences at HDFC Bank, given the fact that you will have Bharat also, you will have metros, you will have self-employed, and varied nature of customer profiles? How do you really think as a digital officer to marry everything and build a very robust, expansive systems?
Thank you, Ashish, and thank you, Dr. Mishra, for having us here. Just to borrow one comment that you made about T-1, T and T+1, today the pressure is a lot more on T+1 to keep on learning, because things are changing so fast that we have to always unlearn and learn. And one of the, thankfully, one of the blessings is events like these, where we also get a lot of master class. What Mr. Chaturvedi just now spoke, and relearn. But what Mr. Chaturvedi spoke, every time we interact, there are some things that we also learn and take away from these events. So that's the good part of being a part of an ecosystem. Coming to the question of how do we manage frictionless journeys for Bharat as well as India, I will borrow from the psychology plus finance interface. See, the citizens actually see the interface that a financial organization provides. And that is where they see the pain of how easy or difficult it is. If we want to drive financial inclusion, we have to make it very, very easy for our citizens to get onboarded and take a particular product or use a particular product. That is the key when we go digital. But the flip side of that is, the more easier we make it, there are opportunities of misuse that starts coming up. There are fraud attacks which start happening. So it's a fine balance that we have to draw. Sometimes we have to sacrifice ease in the interest of keeping it safe. And that is the real challenge. So there are certain competencies that we are building in the bank now, which helps us do this better. So we have created a design shop within our bank, where we have designers who come in and create a panel of citizens and customers who will come in and look at each of the interfaces that we are building. They will seek feedback from them. Is it easy, difficult? And we try and see that we make it so simple that anyone can use it. And when we say anyone, it is people in rural and in urban. It should be easy for young and old. Many a times we get our muscle memory and we are not so adaptable. Youngsters can use it much better. Men and women, well-to-do people and not so well-to-do people can use the same interface. While we have worked so hard to make it frictionless, but this journey is still continuing. I wouldn't say that we have reached where we want to. A good silver lining is now generative AI, which is allowing us to push the threshold a little bit more. What Mr. Ubale mentioned, that now you can use vernacular. We are trying to see if we can bring that interface for customers. Earlier, the whole idea was, can I create a digital form where customers can come and fill it up very easily? And now with generative AI, it is about creating a conversation with a customer to understand what the customer is looking for, bring in the right kind of product in their own language and make it simpler. So that's one part which is helping us drive frictionless journey. The other part is the advent of digital public infrastructure in India. which is a really good enabler for financial services, I would say. When we want to onboard a customer, we look at a lot of details of the customer, KYC, etc. Digital infrastructure allows us to pull and validate those things very easily. The part which still remains to be solved is that currently it's applicable only for few of the capabilities like Aadhaar, PAN, but we need to see a lot of onboarding is still happening on OVDs, what we call other verifiable documents. And a frontline staff is not in a position to say whether this driving license from Uttar Pradesh is the right one or not. Therefore, the paper flows back. There is an operations shop. There is a lot of validations that have to happen. So we need to take the digital public infrastructure to the next level where OVDs can also be validated digitally and safely. And that will help us do the onboarding part a little more easier as we go forward. Then comes the back office part where we do underwriting for customers and lending. There, alternate data is definitely helping in a big way, which helps us pull information and signals, which is way beyond what earlier just the bureau scores used to give. There again, while we have made some good steps, there is a lot to be done between Account Aggregator and RBIH, which is also just now introduced ULI, and no new sources of data is coming in. Some of those will have to move to the next level, like for business, small merchant underwriting, we need a lot of other signals also, which is validated. And that part is in works, some through the infrastructure and some within the bank also that we are looking at. The fourth part of lending journey is the collections. There again, with the infrastructure coming in, which allows us to put NASH mandates early, it helps us collect seamlessly. It helps us, without being very intrusive, ability to collect from the customer, which is really good. A lot of customers forget that they have to pay back on time. Some of these things help us remove that kind of friction. So it's a combination of what we are building within the bank, what the nation is building as an infrastructure, and some of the areas that we still have to solve very well to make the financial services actually very inclusive across. Because there is immense potential. We have not even scraped the tip of the iceberg yet.
That's great. Just taking ahead, where we are talking about MSMEs and the SMEs, this to Ram, we really, and Mr. Chaturvedi also covered it, the account aggregator framework, the public infrastructure, we put in the digital infrastructure which is in place. How do you really see this entire, because supply chain is a blood flowing through the entire ecosystem where it is very, very critical to find credits for the trade transactions with account aggregator, digital, DigiLockers, OCIN, GSTN, and many others which I may not know. How you really see this entire core infrastructure helping building the next level of innovation, and what you are really doing at your place to see that the supply chain can become a supply chain financing, to be more precise, can be a really can go to the next level. Today we still keep hearing that still it is in a nascent stage.
Very nascent stage. So I mean, if you just look at the demographics of India, right? So we have about anywhere between 63 to 70 million enterprises, of which 63 million or 99.1% are below 1 crore of turnover. We only have about 34,000 enterprises above 100 crores of turnover. So effectively, if you look at credit or lending, and if you want to get affordable credit down to the micro and nano enterprises, then I think the entire aspect of whatever Anjani and Mr. Ubale, everybody talked about, I think all will have to kick in. You need lots of data. You need identity solved. You need data, and you need verifiable data if you want to provide that. And one of the interesting things that when we came into this whole space is that supply chain provides a very, very useful construct to kind of map the 63 or 67 million into some context. Because fundamentally, all lending requires a context. And we discovered that trade is a great context. And if we can map large enterprises, which are very well regarded by banks and lenders, and especially banks, you have to get into the party because affordable credit only can come with banks. then they're more comfortable with the large guys. But if through the large guys, if you can map all the way down to the 63 million, then it provides incredible context to the banks to feel comfortable about lending. So I think that was one of our discoveries in the whole process. And my own suspicion is that if you take about 1,000 large corporates in India across sectors and trace their supply chains, well, on both customer and the supplier side, you'll probably be able to map out all the 63 or 67 million enterprises in this country. Because finally, you know, a Panbidi shop somewhere is selling some ITC product, some, you know, HUL product, and you will be able to arrive there. So I think to me, the entire digital or, you know, the DPI framework, I think has really focused on the most important parts, identity and data. And I think we need to evolve it into the next level of data. And I think ULI, NFIR will kind of bring in lots more data than just the typical, you know, charge or, you know, data in there. But I think more importantly, I think we have if you look at it from an abstraction perspective, today GST as a national trade ledger for most of the enterprises in the country, right? I mean, it's above a certain size, but you have the trade ledger across the country. You know who is buying, selling from everybody over a period of time. And then I would say NPCI, RBI put together as the national financial ledger. Who is paying whom, when, what it is. I think one area that would be incredibly, I think, useful would be if you could merge these two in some form. Because ultimately, if you want to lend, you have to know whether people, you know, bought, sold, what did they buy, sell, and finally who they paid, and when did they pay. And I think really speaking from a public infrastructure perspective to me, I think if you really want to solve the problem of providing credit to micro and nano institutions and get them passed, I think this kind of a melding of two very, very large data sets that is very interestingly in India, state-run, state-owned, would I think be the huge, I would say, revolution in terms of able to do that. And I think that if he can kind of get sorted through NFIR, through other mechanisms in the country, I think will happen. Last part I just want to talk about, at least in the trade world, is that we are also seeing a lot of public-owned applications coming out. So Bharat TradeNet is something that the GFT announced. We are going to see that kind of becoming a big place for all export importers to come in. I think RBI was one of the first governing regulators to kind of very vigorously mandate LEI. We are seeing that as a big identity infrastructure across the world. So I think all of this coming together in India, I think the problem for fintechs will actually be to figure out what are we, because I think a lot of the data, identity, and the ability and reach of digital applications, I think will be with the regulator and state-owned entities. I think our job will be more and more discovery and distribution. And I think that's really where we will have to focus on.
So do you also mean that just like when the wallets came in and then the UPI came and disrupted the wallets, so there can be a few of the models which are getting underbuilt can get disrupted by the public infrastructures?
Well, to be slightly controversial, I think digital public infrastructure pushes the innovation, I think, threshold very, very high. And, I was in US recently. It is just amazing to see panel after panel talking about things that I think we solved 10 years back. Right? So, for many of them, the big innovations are things that I think our DPI and regulators and state-owned enterprises have already solved. So I don't think we have that, the freedom and the luxury and the pricing inefficiency to kind of deliver huge results, primarily because in India, we've already kind of moved that threshold very high. I think the interesting thing for India is that, having said all that, and I'm only going to talk about trade and enterprises, not SMEs and MSMEs, a very large majority of 63 million is still underpenetrated for their business financing. So I think there's a huge opportunity. Having said that, I think we'll have to discover, you, me, and other fintechs in this, and the banks, of course. Well, I put the banks last for obvious reasons. But, I think it's very interesting to figure out where is that next level of innovation really going to get focused on.
Great.
Just one comment on digital public infrastructure. We need to look at it slightly differently. See, in a country like China, where infrastructure was built by Ant Financials, Alibabas, those were private capital building infrastructure. So once it was built, it was like a big tech. It was a walled garden. Unlike that in India, this is being built as a public goods.
Yes.
Whether it is a digital public infrastructure or data, data does not belong to any private company.
Yes,
It belongs to the citizen or the entity who's generating that data. This is being enabled for small and medium enterprises, fintechs, and large companies to innovate on top of that. So it is going to open lot more. The way to look at it is slightly different, to see what other innovations can be created on top of the infrastructure. Infrastructure itself should be available as a public good.
No, absolutely. I mean, it's like if somebody asks me, what is the biggest enabling the fintechs happen is the public infrastructure, whether it is UPI, Aadhaar, everything has really enabled what we have built on the top of it as overlays. Absolutely right. Before I come to it, the AI is the buzzword, and I read somewhere the secret of getting ahead is getting started. The secret of getting started is breaking your complex, overwhelming task into a small, manageable task, and then start on the first one. So the question comes is that with AI transforming the digital channels, we have so much noise around it. How do you really balance the innovation with governance, risk, regulations, and what Mr. Chaturvedi also touched upon, the externality of the mission critical journeys which we built over a period of time? How do you really think at ICICI about AI and the governances together?
Thanks, Ashish. Thank you. And a lot of compliment to the Gokhale Institute for creating such a nice ecosystem of T-1 or T+1. But I put it together to a brilliant ecosystem. And thanks, Mr. Chaturvedi, also to not only talk about the regulation, but the rationale behind the regulation and how it's impacting the society as a whole. Talking about, Ashish, the AI and ICICI Bank, I think banking is a business of trust, and it's also for all the people in the financial services. And in ICICI, we always believe that truth, trust, and transparency is the key when we engage with any of our customers. So the framework of AI is no way different than the framework in which we operate our businesses. And the core is like protecting the capital or leveraging the capacity capital and finding out a great counterparty. So our AI framework, if today I look at, it's built on the same framework and broadly 3 pillars. And as Mr. Chaturvedi had spoken about also, for us, the first belief is AI is a capacity enhancer. It's not a panacea or it's not God. It's not the final judgment. We have been using AI, traditional AI, for a long time and many automation processes. But Gen AI part, recently we have started using in our contact center first, in which the call summarization or engagement summarization or drafting of responses. We started the journey from there. Now we have integrated with certain lending models in which it can read, interpret the financial statements and also the regulatory requirements. But one thing is very clear as per our AI policy, that on a standalone basis, no independent credit decision can be taken by any model. Always there is a human in the loop, and that's non-negotiable. That's the first thing in the AI policy. And obviously it's a highly governed and governed by not only by the bank, but also very reputed agencies. It's monitored, challenged, tested by internal and both external stakeholders. And as Mr. Chaturvedi also had spoken about the explainability of the model. Many times what we had seen that many of the models that's very accurate, or that's somewhat very similar to the way we are doing our business or the industry is doing its business. But somewhere when it is not able to explain to the customer or to my internal stakeholders like risk and compliance, we don't put it into the place. And that's a very clear call. So explainability, ethics, These are all the basics, fundamental, and always there is a human in loop. The second pillar, or the part 2 of the framework, is the data security, where the base is the data. And in this, as you have told that it's new, so the technology and the trust are yet to converge. And lot of, it's not noise, but a lot of lack of trust is there on the model. And you hear every day there is a deep fake, there is a synthetic identity. Sometimes you hear about the hallucinations. So that's why we are very clear that the customer data will never be going out to any uncontrolled endpoints. And everything has to be, if there were certain things we are doing, it has to be within the framework of ICACI. And at no point of time we will expose the customer directly to any GenAI model at present. Third part, which is again, every experimentation, it's okay, but we're a commercial organization. So then comes the value realization part. Whatever we have implemented in the contact center, that had taken out the bottom part of the job roles. And where today, if you look at the value realization is truly not fully optimized. But today, when you are putting it into the couple of lending models, which is in the middle layer, that's the decision layer, or the middle management, and where the capital, the risk, and the pricing, all this converge, I hope that there again we can look at some value realization. But otherwise, if you will ask me, we are very comfortable with the traditional AI model. With GenAI, it's a very like cautious approach, because in our business now it is not like doing 100 things right. It is like not doing that single mistake, because one mistake will take away 50 right decisions what we have taken. So that's why, like, while a lot of excitement is there, we are also equally excited to do experiments. But I think it's very thoughtful, responsible innovation we should be looking at. So we are very cautious, and that's always human in the loop, and no exposure of customers' data to any point of time. And I think once it will evolve, we'll be looking at it.
If I put it at a scale, you need to battle with speed versus governance versus data security and all the aspects together. Just taking this point ahead, today if you look at it, the most of the...
Just to supplement what he was talking about, all these tools, we look at them necessarily from the productivity perspective. They may not replace the human in loop as of now. So that has to be there. Because all these technologies, they will enhance your productivity, will lessen your manual work, and will also help in improving the accuracy of taking decisions, but won't replace the humans as such.
So taking this ahead, Sandeep, as we look at it, most of these models are built on the back of OpenAI or Gemini or Perplexities, and most of these, the large LLM models are not in India. They are actually hosted outside India, and we might have built overlays on the top of it. So how does the SBI or the large institutions think about these global models? And is there a sovereign AI is very, very critical for us to really reach the next level of growth, the confidence, respects, and do you see that can become a challenge if the sovereign AI piece is not solved?
There are two aspects to it. Again,
Always.
yeah, always. Global AI and sovereign AI, right? So when we talk, now we are all very highly regulated entities. We are holding customer data, which is a treasure for us. And we need to be very careful that we are guarding this data properly and it doesn't gets leaked or is being used by someone else. Nevertheless, so when it comes to embracing these new technologies, whether it was internet banking, mobile banking, ATM, whatever it is, the main intention was to have a customer convenience, but not at the cost of allowing data to be leaked or the privacy to be breached. So when we talk about global AI or sovereign AI, global AI are equally important and sovereign AI are also equally important for performing certain tasks. You can't wish away either of the two. But one need to be careful as what you will get done from global AI. By global AI, I mean where the data needs to go out of the country. There is no other way. So the lesser important task with the defined parameters and a very limited customer information that can be tried on global AI. And sovereign AI can be used more for critical tasks where the real PI data is getting processed, is used in the models for training, is used for the data set on which the model is being trained. But we are also seeing a lot of investment happening within India for global AI, where we are given assurance that the data is not going to travel outside India, but will have the same capacities as the global AI players, which is a very good thing that is happening. And if you talk about SBI, we have a very strong analytics team, which is a mix of data scientists and statisticians. Around 90 we have, 90 officers we have. And they are developing, they are innovating and developing our own in-house AI capabilities, which we are using for various products. That is what we are moving towards. So there are three things which are happening simultaneously. One is the emergence of global AI, like products like ChatGPT or Copilot that we are seeing. Then the sovereign AI, there are many fintechs which are coming out with very good AI solutions. Our own RBIH, the MuleHunter.ai, which they have designed, which is getting integrated, is found to be very effective. And this is all done by our own boys and girls. There is no global player involved there. And third thing is, in India itself, the capacities are getting developed because of the tremendous opportunity that is being made available. So going forward, it will be mix of all three. Only thing is that being a regulated entity, one need to be very careful as where to use which technology, because we cannot afford, even if we want to trade off customer convenience, that is fine with us, but we can't afford any data leakage or breach of data privacy. That is how I will put it.
Fair point. Anjali, let me put you on spot. We have today's topic is innovation and regulations together. So just out of curiosity, what are the innovations which has really helped taking a big leap at HDFC, and what could be the biggest regulatory bottleneck which has slowed down the digital innovations as per you?
So the biggest lever has been for big innovation has been the DPI part. How we've leveraged it, I think that has been a big leveler. Lot of things which was only earlier a prerogative of any one organization, now it was available to anyone, whether it's a small fintech or a large regulated bank, you have equal chances of winning as long as you use that. So that was a big leveler. And we see a lot of potential to grow that further, including the account aggregator system or the ULI piece which is coming out is going to provide a lot of information in a safe manner with customer consent, of course, which we will have the ability to use it to take it forward. In terms of the regulatory unlock that you're talking about, I think in terms of getting more data, there is a lot more data. In the digital world, the only two things that differentiate us from anybody else would be the experience that we create and how well do we know our customers, which is coming from the data. And that part potential is lot more from where we are today. And that's one place where the information exchange between the banks can go up big time if the regulator steps in. And we are seeing that one of those areas is DPIP that you are hearing about. A lot of data which can be shared between banks very quickly will help us prevent fraud. That is one area. There are many other areas like that where if just banks exchange data on a real-time basis across, it is going to help us improve the experience much more from where we are today.
Fair point. Coming to you, Ram, when you started, I remember because I closely followed you. You were more of a connecting the banks with the end supply, the creditors, traders. But over last couple of years, you started evolving towards thinking around being a regulated NBFC, etc. So the question comes: is it because of the scale at which you start thinking around NBFCs to be in the fold, or is it something regulatory? What really prompted to become a regulated entities in the regulated world?
Well, it was not an easy decision, but I think when we talk to our banking partners, right? I mean, and the moment you start going down the supply chain and you start talking to smaller and smaller enterprises, I think the need for providing some form of skin in the game, I think obviously was one of the topics of discussion. And given the regulatory guidelines that you need to be kind of LSP or co-lending, I think is another very important thing in our business. You need to be a regulated entity. So from our perspective, the NBFC was not to kind of was to figure a better way of collaborating with banks. We work extensively only with banks, primarily because for us, affordable. I just want to give one small fact also that I think most people sometimes don't understand. In India, across all the sectors, barring about 5-6 sectors, the net margins for most micro and nano businesses is less than 2%. Which means credit cannot cost you more than effectively 50% of your net margin because you are then taking it away. Which means that you have to afford to give credit at about 12% a year. Which means it's obviously very difficult to price risk to these guys at the 12% mark. The only way to solve it is to obviously data, your algorithms, your underwriting, and everything else. But I think the fundamental also aspect is to be creating a context, as I said, of the supply chain to help them to kind of be able to lend there. So becoming a regulated entity was really about figuring whether we could partner with our existing bank guys in expanding their access in downwards into these enterprises. Because the moment a bank lends to a small enterprise, I think their credibility, their respectability, everything goes up. Their ability to be financially literate also goes up. Because most of the times, we classify, going back, Mr. Chaturvedi talked about, need to educate. About 70-80% of enterprises in this country are credit unready. In fact, one of the things that I argue internally is that lending can never be frictionless. Because you have to kind of first teach them about the obligation of credit. Unlike payments, which can be frictionless, credit cannot be frictionless. Because you have to make them go through pages of document. And one of my learnings, at least when I first went out to the to onboard guys, I figured out people were just signing on Aadhaar-enabled signing without even reading the document. So, whether you give them a one-page key fact stay sheet or whether you give them 200 pages of contract, it really doesn't matter to them. Because in their context, it is just getting the money, right? And not really thinking about what that obligation is. So, to be a great, important thing is that when you want to penetrate downwards and you want to make sure that these, and while we talk about fraud and all that, actually, honestly speaking, in now about 30 odd years of working with that industry, fraud is actually the smallest problem statement. The fundamental problem statement is that and we talk a lot about cash flow based lending. I mean, honestly speaking, 99% of our enterprises don't have cash flows, that they can actually measure and monitor and manage. One medical crisis will take away all that cash flow. So you effectively have to think about a lot of ability to kind of, I think, work with these guys. And I think just as a, at a fintech alone would not have given us the ability to kind of participate in that, and therefore the regulated part. Having said that, I don't think our intent is to build a book from that perspective or make it a profitable enterprise. I mean, it will be obviously very profitable. But what I mean is that is not the reason to get into it. It is really to figure out how to kind of provide access to that credit across that supply chain. And I think that 63 million to me is, we have also not even scratched the surface, is the biggest, I think, problem area. Because, one other socio-economic indicator to think about, and I don't know whether we measure it, is that how many micro enterprises become small enterprises? How many small enterprises become medium-sized enterprises? How many become large enterprises? Credit is obviously one ability or one lever to do it, but there are many levers required. I mean, it is not just that question. So I think unless you're involved in that, you are going to kill your own market, because, you will lend, the term I used to use very jokingly internally in the office is that most lending to this 99% guys is spiritual lending. Because you essentially, whatever model you use, whatever alternate data you use, once you give money, you have to just hope and pray that they will return it back. So you really have to create the mechanisms that they will be able to pay back, because for them it is important to pay back. I mean, no business really wants to be in debt where they have not paid, with their people chasing them and all that. Most people really want to pay on time. The fact is, it's beyond their capabilities. And how do you kind of take care of that?
I hope you don't tell this to your investors.
Well, they have patiently listened to me. Hopefully, they will.
So I'll just pick one word which you spoke about collaboration. And today we keep hearing fintechs are disrupting the payments space, lending space. Also, in globally, we have seen few fintechs taking over banks or becoming converting into banks. How do you really think? The fintechs which has really evolved, most of the payments are now actually routed through fintech companies, the entire UPI ecosystems, and there are lending companies like us who are building this. How do you really see the collaboration between fintechs and the banking banks from a collaboration perspective? What are the opportunities? What are things which you think at a scale can be really worked collaboratively and which can really achieve the overall objective of, let's say, Viksit Bharat?
Actually, there is a lot to learn from the fintechs. And banks like ours, we might have little deep pocket, but also along with that, there
just
is
including spiritualities.
but along with that, there is a multiple types of risks we get into our balance sheet. So we are very clear in terms of our decision that what we should do ourselves, and where we have to have a great partnership with our fintechs. Something which is very core to us, like suppose it is reputation capital or the financial capital, all my customers' data, or certain models which is very unique to ICICI. Either it is risk or pricing, or it is the enterprise-based risk and or fraud risk identification model, that we choose best of the counterparties, and we co-create, own it, and monitor it. The way we manage our digital platforms, or the way that we manage our data lakes and all those things. Now, when I look at the fintechs, their ability to deep dive into a particular segment of the customer or a particular challenge or a problem in the society and finding a unique solution is far, far better than large like banks like us who are into multiple types of businesses and multiple segments of customers. So there again, we feel that we can complement each other in terms of creating a very agile ecosystem. I suppose in our journey, like customer onboarding journey, what Anjani had spoken in the morning, a part of it is, yes, it's with me, but a part of it, suppose a video KYC. That journey, if it is being developed, proved, very, very compliant, and very well managed counterparty, then it's better to get integrated there. In terms of taking certain decisions, suppose there is an account aggregator ecosystem and and once you get the data, then again, if it can be synthesized, and with all the guardrails of the compliance, if you can get it in a consumable form from any of the fintechs, then you use it. So that's why some of the important part of the journey, where you feel that a fintech adds a lot of value, very, very agile, then we integrate it to our core model. But there again, as a bank, we're very, very cautious. Okay, one thing again, which the selection of counterparty. Because as a bank, it's a huge reputation risk. When I lend my name, I carry a huge reputation risk. There again, we just look at the counterparty who are having equal respect towards the governance, compliance, and relationship which are long-term sustainable. That's one type of relationship we look at. And somewhere again, if I find that any fintechs are solving some of the unique propositions and which is having a very long-term future in the society or solving very unique challenge in the society, then within the regulatory limits, we become an equity partner also. So that's the three way we put out decisions, like what we should do, we are very clear. And that's the core part of it, where we can create an agile ecosystem and with whom. That's very, very important, Ashish, for us.
Absolutely.
Okay, and the last is if we find out a business opportunity along
We'll do
with the ecosystem, then we do it together.
Absolutely. While I have a lot of questions, but I just want to check if there is any questions from the audience to ask. Yeah, please. Can you just come up and is there mics for them?
You mentioned that you're using GenAI on chatbots, and rightly is underwriting chatbots are used for customer support and all of that. And second GenAI use case you very rightly pointed out was calling people on for correction. Right? So my question is, what is the third step? Why are we just scratching the surface here? Is there anything really fundamental that you guys have thought of regarding in terms of GenAI, not just a customer-facing chatbot or bugging people like calling them for robotic voice?
Very interesting question. Are we just scratching the surface with customer support or chatbot, or we are actually using GenAI at a scale?
Yeah, thank you for that question. All four of us were telling how these technologies are evolving. And Anjani did mention that it's only the surface that has been scratched it's only the tip of the iceberg that we are scratching. These technologies do provide tremendous potential. And while they are evolving, and GenAI is only 3 or 4 years old, though traditional AI is almost more than 50 years old. So we are still evolving. And since regulations are in place, and we all need to be very careful while exploring these technologies, I think the next stage, what your question is, we are having huge data which need to be processed upon for making our decisions more fine-tuned to the extent possible. Despite that, as he was telling, that unless and until the creditor has an ecosystem which helps him to pay back, no matter whatever model you use, the default is going to happen. But notwithstanding, nevertheless, about these limitations that we will still have. But the next which is coming up is DPIP, Digital Payment Intelligent Platform, where all these technologies will be of tremendous use in giving a score the profiling will happen and the score will be given to the individual person who is coming to the bank or the customer, and then it will be left to the bank which has to deal with that customer whether to go ahead or not to go ahead. So that is the next step that we all regulated entities are looking forward to, which will definitely bring down or will be more proactive in preventing the possible frauds. So I think that is the next stage what we are looking ahead at. And at individual bank level, there might be several internal use cases where this GenAI is being used. Like I can give SBI example. Recently we centralized at our trade finance business at 2 locations, Hyderabad and Calcutta. Instead of every branch getting into it or the local CPCs getting into it, it has been centralized at 2 locations. And we are going to install a GenAI tool to detect the onerous clauses in the LCs and BGs. So that when we open any LC or when we issue any bank guarantee, the underwriter will know upfront about these onerous clauses, which otherwise, if you do it manually, sometimes there is a possible that because of the workload and the timelines against which you are working, you are likely to miss out. But this kind of tools will help in detecting these onerous clauses upfront. So that is where we are moving. I hope that satisfies.
Any other question?
Just adding to Sandeep. See, there are multiple use cases. Voice is one what generally we are able to see and experience it. But as Mr. Sandeep had said, that onerous clause, or in our bank we are looking at credit proposals, which takes generally a person to prepare for almost a month time of a large corporate banking credit proposal. Today, 90% of that, you can just make it in 10 minutes of time. The rest, you have to spend 3-4 days or 5 days to understand better about the company and again engage with the promoters to find it out. Even if, like my asset management company, about the investment performance or the performance of different sectors or the research team, okay, they are absolutely on this GenAI format. See, the crux is, do I have the confidence to share my customers' data with this model? Or as long as I can use the public available information, with that I can create efficiency. I think you are absolutely right. We are on the scratch. We are just on the surface of it, and we are just trying to evaluate. But I think it's only once you build the trust on the model. Technology is there. Technology can give you certain sort of outcome, but once you have the trust, then only you can you can share your own information.
There is a time for one more question. Otherwise, I have a question. Please go ahead.
Right now, only the NBFCs are into lending to those kind of users. So, are the major banks going to enter that arena, or like what is the stand right now?
We already have a product where we use machine learning and AI extensively for giving pre-approved loan to non-salaried people. Means these people come from that section of the society where they may not have a steady flow of income or revenue. But after using these tools, we do realize that their credit worthiness, the required credit worthiness is there from the flow which is happening in their accounts and the other data that we collect. So yes, NBFCs are in the forefront in tapping that market, which is unstructured, where scheduled commercial banks perhaps are less inclined to go ahead with this kind of population. But every bank does have within itself some product, whether small, medium, or big, to tap this kind of customers as well, because all these things are available. And as Anjani was repeatedly talking about the DPI, and if we extend DPI further to look into the local records, the telecom regulatory reports, or the telecom providers information, or the local municipal authorities records, then we'll be able to have some decisioning which will come out of the unstructured data, which is normally not available. But as we are expanding DPI further, hopefully a time will come that even this section of the population will be able to benefit it by most of the bigger banks beyond NBFCs. That is how I would like to summarize it.
Great, thank you. So I've been told we need to close. So last quick fire 15-second answer. One myth about innovation at your institute which you want to break. Starting with you.
Yeah, AI models and GenAI models need a huge data set. And the more richer these data sets are, the more better the model will be. But the risk that I am carrying is that these data sets have some sensitive information. Can I have an innovation where there is a synthesized data, anonymized data available for training this model? And the results will be as good as the models that we are creating. That is one innovation we are eagerly looking forward for.
No, one myth that I would like to break about my organization. Well, it's around innovation. Actually, innovation is not a prerogative of any one department. Right from the person who's at the front line, who's talking to the customer, to the smartest credit manager, everybody can innovate. There is enough to unlearn and then learn. And we need to have that mindset to keep changing for the interest of the customer.
Well, I think as a fintech, I think the first thing we have to just understand, I think internally, is that AI is innovation, but innovation is not AI. Otherwise, everything is now just AI. Yeah.
For us, that again, as building on the like what Anjani had spoken, that innovation is not adding new features. Okay, it is or not having shiny tech or like AI or something. You're not missing anything. I think innovation is changing the mindset of building a deep empathy about the customer and building in the framework of fair to the bank and fair to the customer. Okay, because today many times it's little lopsided towards the something what you are doing or your employer. So fairness towards the society, fairness towards the customer, that's I think something we have to balance it well. And a lot of innovation can be done without tech. It's on the communication in terms of product features and how to put it everything in a very simplified way in the digital platform. That's the myth what we want to do.
Amazing. Thank you very much, everyone. I really enjoyed moderating this session, not answering, asking question for a change. Thank you very much, and thank you, audience.
Thank you for that truly engaging panel discussion on innovations at large-scale financial institutions. I would now request Ms. Tanushree Nirmal to present our panelists with mementos. I now request Tanushree to present the memento to our first panelist. I now request Tanushree to present the memento to our second panelist. I I now request Tanushri to present the memento to Mr. Siddharth Mishra. I now request Tanushri to present the final memento. Okay, second last. Thank you. Now request Nipur to present the final memento of this panel discussion. Thank you so much. I now request the audience to put their hands together again as the members of this panel now take their seat among the audience. I request the members of the audience, those who are seated in the low rows that are towards the behind, to kindly come and be seated towards the front. Members of the audience who are sitting towards the behind are requested to come and be seated towards the front rows. Thank you. I would request the volunteers to assist them and bring them towards the front rows. The next panel discussion taking place will be on the theme of new frontiers in digital lending, product diversification, new segments, rural credit, and resilience in collections. It gives me great honor to introduce and call up on stage the moderator of this panel, Mr. Srinath Sridharan. He is an independent consultant and corporate strategist. Now I call up on stage our panelists. The first panelist who I would like to invite on stage is Mr. Akshay Mehrotra, the co-founder of Fibe. Our next panelist who I request to come up on stage is Mr. Anurag Sinha, the CEO and founder of OneCard. Next, I invite on stage Mr. Satyam Kumar, CEO and co-founder of LoanTap. Finally, I invite on stage Mr. Nikhil Korhe, the CEO of Fenarkin. Let me introduce our moderator to you. Mr. Srinath Sridharan is a senior corporate strategist. He has over 2 decades of experience across automotive, e-commerce, advertising, and financial services. He spent 13 years in leadership roles at Vadwan Global Capital. He is a member of the World Economic Forum's Closing the Skill Gap Task Force and its Infrastructure Advisory Board, an honorary fellow at ORF, and he is a fellow of the Institute of Directors. He is also a mentor to young professionals and an advocate for responsible, inclusive consumer access. Now, let me introduce my first panelist, Mr. Akshay Mehrotra. He is the co-founder of Fibe. Mr. Mehrotra is the visionary face of one of India's most disruptive and profitable fintech success stories. With a bold mission to upgrade the financial lives of young India, he has transformed Fibe into a pan-India powerhouse, serving over 25 million users, also disbursing rupees 30,000 plus crores in loans and pioneering innovations like India's first numberless credit card. Let's put our hands together for Mr. Mehrotra. Our next panelist, Mr. Anurag Sinha, is the CEO and founder of OneCard. He is a seasoned leader with over 2 decades of experience in consumer credit and payments. He previously spent 14 years at ICICI Bank, driving growth across cards, loans, and structured finance. Earlier, he served on the board of Sarvatra Technologies. Mr. Sinha at FPL is reimagining the credit card experience for a mobile-first India. I request the audience to put their hands together for him. Next, we have Mr. Satyam Kumar, the CEO and co-founder of LoanTap. He is an industry veteran with over 19 years of experience. Before founding LoanTap, he served as a national head mortgages at IndusInd Bank, where his efforts resulted in a loan book of over 5,000 crores in LAP. He held various positions at ICICI Bank and was instrumental in launching the sanction guarantee scheme in the Indian lending ecosystem. So let's put our hands together for Mr. Kumar. Our final panelist is Mr. Nikhil Kurhe, the CEO of Finarkin Analytics. He pioneered a deep tech company building trusted data products for India's BFSI sector and digital public infrastructure. At Finarkin, he drives the product roadmap, business development, and ecosystem evangelism, enabling enterprises to leverage AI-driven, real-time data solutions for onboarding, underwriting, credit monitoring, collection, and financial insights. Let's have a round of applause for Mr. Kurhe. Today, we are talking about an industry that is changing faster than most people can keep track of: digital lending. An industry that once meant simple online loans has now become a complex, data-driven ecosystem, rewriting the rules of credit. Across India and much of the world, millions are entering the formal credit system for the very first time, not through paperwork, but through smartphones, algorithms, real-time data. And this shift is opening new frontiers. Let's put our hands together as I hand over this session to the moderator, Mr. Sridharan.
Good afternoon. As the villains who are keeping you before lunch, so we will be prompt and I think responsive before 1:15. I think so we already I've been told that we've been running behind schedule and we'll have to wrap up by 1:15. And I think as somebody who knows them, and I think we can write a book on this topic and try to summarize it in half an hour. It's almost a Twitter version of what we are trying to do. So let me set some context, what we are attempting to do. I think it's a topic where the moment you said fintech in India and you, sorry.
Our panelists need to be presented with the bouquets, so I request the student in charge to kindly come with the bouquets. I request Ms. Biborni Dawn to present the bouquet to our moderator, Mr. Sridharan. I request Ms. Vanshika Jain to present the bouquet to Mr. Akshay Mehrotra. I request Ms. Biborni Dawn to present a bouquet to Mr. Sinha. I request Ms. Vanshika Jain to present a bouquet to Mr. Kumar. I request Ms. Biboni Dawn to present a bouquet to Mr. Kurhe. Thank you.
Thank you.
Let's continue with the panel.
Thank you. So some courtesies, I think it's always, for me, my special thanks to Dr. Rabi Mishra, sir. I think it was more a summons than an invitation, considering that's a liberty he has with me. And two, I think to the Vice Chancellor for making this an important topic. And three, to the faculty and the students here. So let me, with that, come to the topic. What I think we should jump on is, I think we've all been speaking about credit. And the moment you say fintech in India, people instinctively, and this is my personal opinion, so don't attribute it to any of my formal association, including through the fintech SRO. The moment you say fintech in India, we jump to payments. Intuitive, because almost all the political and the bureaucratic speeches are actually speaking and referring to payments as an industry. And here we are sitting and talking about an important aspect of lending. So I think it's very important to understand that differentiation of fintech. So, and in lending, it's very easy to lend. Well, I'm oversimplifying what they do, but it is very difficult to collect. Your lending is not over until you collect the last money every time, every little time. And I think that's a larger context. I think we should bring in the challenges and the difficulties. So the question is not about can we scale digital lending anymore. I think that topic is, we have crossed that topic a couple of years ago. More importantly, can we scale digital credit, I think meaningfully across segments that are underserved or misunderstood. I think that will be important context for the panelists to bring what they have seen. And why is it different? I think very simple. There are 4 stakeholders in this room. The regulators, they focus typically on systemic stability, consumer protection, and ethical growth. And the assumption is typically there is a constructive tension between the industry and the regulators, with the assumption that you don't have it. The industry doesn't have it. And the fintech innovators unlock and focus on actually removing friction. They believe friction shouldn't exist. And they want to use that to unlock economic value for their enterprises. Students and researchers here typically focus on institutional design. And the industry practitioners will bring you topics of risk, execution, operational issues, customer experience, all of that. So how do we balance all of this in collections? That's what I want to weave into. And more importantly, how do you understand credit as an ecosystem? Because the consumer segment is right from 18 to probably 65 years of age, and it is changing. And there was a time we spoke of India as India, and we also use the word Bharat to say rural, uneducated, illiterate. But it's no more the context. It's changing. So how do you see this opportunity as well as challenges? So what I would like each of you to focus in your 5-7 minutes opening remarks is this. In your own journey, what have been the biggest lessons, especially failures, that you haven't spoken about? Because everybody sees your success, but for every one success, you probably have had 8 to 10 failures that has made that success far more robust. Speak about that so that it's a great opportunity for the students to learn from. And 2, I think, what is changing fundamentally in India as consumer behavior? I think these are the 2, I think each of your address will be great. Akshay.
So Srinath always puts the question in a tougher manner. I know Srinath now for more than 10 years. I'll put 2 points about him before we start the panel. Right. The first is, if he's putting a question, there's an underlying difficult question going to come just after a few minutes. So he's asked us a thing, he's going to ask another thing, it's going to be extremely difficult. The second is, he always wants us to tell something because he knows the problem in the way we are running it. So don't think that he's telling you to give the answer, he's pointing it out, improve what you're doing further. Now, coming back to what he actually articulated, that giving money is easier, collecting is tougher, which means the infrastructure has to be built to manage the money going out in a better manner. See, fintechs first went and solved the problem. So digital lending fintechs first went and solved the problem of who to give money, build a concept of algorithmic way of working, so the efficiencies in the company become better. And let's say companies like ours can run business of doing millions of loans with very little number of people. So we can lend business in a more efficient manner. Banks have an advantage that their cost of capital is lower, our advantages, that we can build more efficiency in business so that we can compete equally at the end consumer gets an equated product. See, as we mentioned, that the KFS document clearly shares what you're going to charge, right? Now, the comparison between me and the challenging bank will be exactly same for the consumer, right? And because of the efficiencies we bring in, there's a competition possible. The second part is giving is easier, collecting is tougher, which means that the effort that we had to do from day one was on the collections efficiency, right? Our company has never done the sales event or ever done an event to talk about what we do for distribution, partnerships, selling, and we have had a fair success of attracting more than 4 crore people who have come to the platform. But what we celebrate, encourage, and invite partners are on the collections franchise. Every year, 84 owners of our collections agencies travel all the way to Pune for a 2-day event where they get trained. Their gala dinners also achieved at the end of the day, where they're recognized for the best work that they do and how they provide infrastructure for us in the collections capability. Now, we mentioned we are great in giving money. It was also we have to be great in collecting money back. And that infrastructure almost includes 3,000-4,000 people who help us get the money back, right? The second part is really building the platform technology also run the picture. So today, all these 84 agencies, almost 3,000 people, run a single CRM built for collections using better capabilities, which means when the door knock happens, is it being knocked at the right address? When the customer feels we are getting aggressive, is Jet generative AI available at the back to say, no, we were not. Who was the aggressive person in the room, right? So the efficiencies can be managed in a more better manner. See, differentiation is not when you only look at problems at one side of the candle. If you really have to build a large business, you have to solve for both sides of the business, giving and collecting. I hope I summarized the first question. The second part was, when did you fail and can you glorify your failure? Many a time it's a big question tag, did we do it correctly? And I'll give you 2 indicators of where we miserably failed. The first one was we came from some learnings. I came from the learning of running a large retail operation at Future Group, which meant that we said, yeah, we can always compete on a physical POS to also give a loan for a transaction product. That's easy, we'll always do that. It was the first product that we buried within the first 5 months. We said, listen, if you're going to do a physical product using a digital atmosphere, you're going to be too expensive. Let's shut it down. It doesn't make sense, which means everything should be digital. We don't want to enter a business. The second part was the core of the company became a problem definition. We were called early salary, right? If we only, and we were getting stigma to the category of what we really do, which means we only cater to early salary as a category, not just a product. And we reinvented our name where we called it Cooler. We found a nice 4-letter word to demonstrate what we do. At the same time, we launched a series of products which meant we give unsecured loans for every use case. And that's a very important learning of destroying your own category that you built, right? Because you're getting attached to the category. That marries to your third question, Srinath. Are you really causing impact and can you demonstrate that impact as you do? See, when you give loans, in most definition in the world, it's a loans by design cause impact. But that's not really there, right? You don't know what the person takes the money for. He may say he has a wedding at home. He may be holidaying with that money, right? He may just want to survive the month. He may just want to pay for a medical emergency, or he may actually just be frivolous enough to pay his credit card bill from the money you gave. We said, why don't we also go build a use case where we are considered more ethical? We really showcase impact. And we started that journey 3 years back. And today, 43% of the loans that we do is for a use case of healthcare, digital skilling and schooling, or to buy, let's say, insurance. Now, interestingly, people said, isn't that close to buying a loan for a mobile phone? We said, yes, it is similar. You can have a medical emergency and you need to pay 100,000 just like an iPhone. But the use case and the mindset is very different. Convincing Apple to give you subvention is very different to go to a Narayan or a Ruby Hall or a large hospital to give us interest subvention, right? Because there's not 4 brands who make mobile phones. These are hundreds of hospitals across the country, spread across hundreds of cities, providing treatments and very complex work happening. And building that network made a large differentiation. Today, we are available in 8,500 hospitals and clinics, giving zero cost EMI. We work with more than 100 universities, providing skilling opportunities to working professionals and building a challenger product, right? We are the largest fintech in education. We still don't do an education loan, right? And that's interesting areas. Then you start demonstrating impact. And what's important when you demonstrate impact, it also then showcases the company is very well built, is differentiated. It can build a second business. It's not just known for one business, and it can be showcased to the entire country of not just doing a cute product for the tier 2 city or tier 1 city, to really cater to a cross-functional customer base. You do need skilling in people who work in Bangalore. You do need the same parameter when it comes to hinterlands in Karnataka, right? And when you really focus the same area is where the cusp changes. Fintech, not just for upwardly modern customer, but fintech which really reaches to the mass India and really believes in Viksat Bharat actually happening.
So let me bring you in, Anurag. I mean, I think for a change, if I were a borrower, I'm say 24, which I'm not, sitting somewhere in a pin code which is not otherwise in your top 10 cities or categories, how would you see me very differently? And you have to, in your entire address, this is a tough one. You will not use Viksit Bharat or any of those. Think of it from that consumer's journey, because not many people understand the consumer journey that as fintechs all of you go through, right? You actually go through a lot of processes and layers in understanding consumer behavior. You don't even physically see them, and they don't even see you. So what is the concept of even branding? If somebody says ICICI Bank and HDFC Bank, you see a giant mammoth and you worry that somebody is going to turn up in your house or whatever. But in this case, how do you collect, and what is that entire journey?
Thank you, Srinath. In fact, I'm so happy that you started with the statement you made that fintech is not only payments, because many of the forums, because payment is the largest category in fintech, it kind of consumes most of the bytes. Definitely coming for a category like credit cards, which are linked to payments as well as lending put together. And it's also a very large brand game, because the association of the customer stays with you for long. The entire ROI in credit card business gets built because the customer stays long with you. And how do you build a brand when you are a new age brand not associated with the bank? So I think 2-3 things came to our rescue. One, we work with banks. So of course, banks logos are attached to us. So we kind of ride on their brand equity. Having said that, we have been around for 6 years, and we started our journey with another product called OneScore. So OneCard came almost a year and a half later, when we were already known as a brand in the market. And OneScore was built around helping Indians understand their credit health and how to educate them to maintain credit health in a good manner. And this is very, very important, because on one hand, credit card brings very large, I would say, flexible credit. It also helps people build credit history, which enables them to access larger form of credit in future. And because almost 60-70% of the outstanding in credit card business is transactor balances, where people use and they pay, but they end up building history. At the same time, revolving credit is not easy to understand. It is pretty complex. So one has to educate people about how to manage it. And we as a brand started our journey on OneScore. By the time we launched OneCard, we almost had 2 million plus consumers using us on OneScore. And today that number is more than 60 million. So that gave us the trust factor to start with. And of course, we rode on the brand equity of the bank partners we partnered with. Lastly, the credit card as a category is fairly underpenetrated. Every form of credit is underpenetrated, but credit card is specifically underpenetrated. Of the 100 million cards we see today, 50 million have been issued in the last 5 years only. while the industry has been around for 30 years. So the last 5-6 years when we have been around, fortunately, the industry also has grown in a big way. So we could ride the wave of the penetration of the category. That's one. I think you asked a very good question about talking about few learnings. I would call failures. I'd call it learning for us. One is specifically what we saw when you go beyond from 20 cities, thanks to mobile and DPI, the reach is fairly large. You have similar data sets available across the country. What we see, the language of finance continues to be English across the country. But when they want to understand the product, they want to speak in the vernacular language. So, in fact, many a times when we have done campaigns in vernacular language, they have not given us the results. People like to deal with you in English, but when it comes to asking questions, so your customer service, your collections definitely have to be in vernacular language, because when they have a problem to ask, they don't go to English, they go to that. So that's been a big learning for us. We've been India, initially top 20 city play. As we expanded to 100 cities, we had to build tons of vernacular capabilities in our customer service and collections to be able to cater to that population. And second insight, is that when you are building a collection, one of the reason why majority of the credit value chain, be it underwriting, distribution, has been organized, collection is still fairly unorganized activity, because collection requires allocation every month. Now, it's very difficult to predict that will you get the allocation next month also or not. Barring few banks which are running very large balance sheets can predict much better, and that's why they are running the large part of the organized value chain. Thanks to technology, this organization is happening, and this was again a big learning for us, that if we have to drive large collection, large credit penetration, we also have to organize the collection value chain. Something what Akshay spoke about. How do you include them in your thought process, not only just use them on a use case basis? Okay, so that's been a learning for us. Last thing you see about how do we see between large city and small city. I think aspiration is one word which is all across the country. I don't think the person sitting in Pune and Mumbai, and at the same time, let's say I'm catering to a customer in Satara or Kolhapur or Nasik or even further down to Latur, the aspiration levels are almost exactly the same. They don't want to wait for it. So that's one word which has really stayed in our mind as we build our product beyond these cities.
Thank you. So I'm going to bring in Satyam here. I mean, again, somebody I know for many years, MNC banker to Indian banker to finding a fintech, founding a fintech, and to take on what Anurag mentioned, collections. I mean, the aspirations of what I call millennials and Gen Z is almost the same. And I think we've also been seeing it for the last 30 years, thanks to the satellite television, internet. Almost democratization of finance did not happen only by any of us. It happened by social influence and social change. But has it changed collection? Because end of the day, I want that car, I want that jacket, I want that ticket to Coldplay, but will I pay back when you call me on time? Will I pay you back on time? And what is your struggles and challenges and learnings?
Thank you. So I think we'll have to see collection the whole process from a socialist versus capitalist mindset also. I mean, rather than only looking at it as a standalone process, has it changed? So if we look at a perspective wise, then the way governance, the policy making, and all the ecosystem, they will say is that they will pick up a couple of cases and they will generally color the industry. Okay, I think that's something wrong. What fundamentally has changed through lots of regulation which has come in last couple of years is we didn't get into any of the the way things deteriorated fast in China or in other Southeast Asian country, particularly when it came to small lending and when it came to informations about informations and things that people were willing to share to get a credit or to get the first credit. So the first article which when I started writing, I wrote about how much is too much, how much you should share when you have to borrow. And at that point of time, China was still dominated by P2P, and all of a sudden 400 plus companies had been downed overnight, where people were as a collateral, people were sharing nude pictures along with the numbers like a Kaidi, okay, and that used to be kept as a collateral. So the issue is that there have been instances where institutions has been scrapping messages, scrapping contacts and all. Practice-wise, regulator has done a wonderful job in terms of stopping many of it in last 3 to 4 years, and they have worked very and a lot of kudos there also to face. I mean, the whole ecosystem has worked very closely, including the industry participants. I mean, whether it's one card, five, loan tap. I mean, that's where most of things started when things picked up during COVID, when the stress was everywhere. I mean, sympathy was everywhere, but at the same time, stress was also everywhere. So there could have been no better moment to judge, to the extent things can deteriorate. So, at the same time, I mean, bringing back and looking at a lender that one instance or second instance coming as a hey, the lenders, all lenders are like this, okay. So that's a typical, that as a democracy we have been we have to play out, we have to live for each day. Has the process for the entire ecosystem changed? The answer is emphatic yes. From our own perspective of a collection, the way we see is that collection is less about coercing, okay, more about nudging, where at the same time you also have to give a support. You have to give it support in terms of, particularly when you are dealing with the segment where one medical instance or some other stuff happening in a family can derail the entire financial planning for the whole year. So from that point of view, it's more about nudge, being there, staying there, rather than just going and just hammering out. But hammering out has not given money to everyone, neither to a traditional banker nor to us. So that's how we have been looking at a collection, and I think a lot of this payment railroads has helped dramatically in terms of creating those nudge mechanism and all, rather than really a hard-coded way of the way it's viewed as a collection, as an activity. And most of the, I mean, in a banking also, we always knew that the best of the guys, best of the bankers, or the best of the collection guys were actually the intelligent people. They were not like a brute, the way the collection is portrayed by way of the picturizing it. So that's the entire, and half of the banking system you will be able to name a CEO or an MD who actually came home from a collection ecosystem, collection backdrop, rather than, or they had a large stint in a collection rather than only being a classic banker or a lender or a corporate banker or something like that. So that's how we see a collection as a nudge, and they're just extending it to the fintechs. What fintechs has been doing is that fintechs has been doing a great job in terms of information, sharing the information. And that's the railroad where the traditional ecosystem has been missing. And the moment you see demystifying the whole process, sharing more, like going all the way down to a vernacular language, जैसे आपको इसमें comfortable है, इसमें बात कर लेते हैं. Okay. So doing all of it is just to make a customer comfortable, just to make a borrower comfortable with the ecosystem, building a trust. We have a bigger challenge because we can't go back and say that, hey, we are like this, take it or leave it. Okay, we are there as a challenger. Okay, so our response is very different, and our entire response system is about connectivity and nudge. It's not about anything else, as far as the way we see, and we give a great a lot of share goes to regulator, policymakers, and all, the way things have spanned out as far as the collection ecosystem is concerned.
Thanks, Satyam. So I'm going to come back to all of you with a couple of my own questions. So to Nikhil, in the previous panel, we heard all of them. I mean, the only word I didn't hear, Ashish says Jai Ho. I think positive about the public digital infrastructure and all of that. And there's a dilemma there. As private sector industry is sitting here, we have only built and packaged around it. We have not innovated. The Western world innovation came from private sector. If DPIs and the JAM Trinity did not exist, none of us would exist as an industry. That's probably the reality, because we wouldn't have the depth of private capital to throw at innovation. So with that in mind, the reality is there's a lot of unstructured data that is there, despite the structured data sets. And in your world, looking at data analytics and working with the financial ecosystem, what are those, let's say, green shoots that you still see for newer products, newer segments? Because the reality is there is a lot of consumer segments that is still unaddressed, unmet. I mean, in my 30 years of corporate life, I am tired of listening to financial inclusion, financial literacy, digital literacy, women borrowers, MSME, SME, very standard. I think somewhere in our annual calendar, we all have certain days. Banks have to celebrate saying financial literacy day, literacy day. You guys don't have to. What are those white spots, gaps that you see, which is what will make consumers trust more on digital? Otherwise, digital really doesn't mean to them if they come to Fibe or Loan Tap or any of those and they don't get the money, they're not going to trust him anymore. I mean, he didn't give the money. That's all people think. So white spot for one. And two, what is it that we still are not thinking about data as an ecosystem?
Yeah, this is working. Okay. So I think great questions, great panel. And I completely agree with what Ram mentioned that with how the open standards and digital public infrastructure has evolved in the country, the bar for enterprises, the bar for startups, the bar for incumbents, it's a lot higher. It's a lot higher for us to justify our existence, forget value, right? I think Finarkin as a company, we have unfortunately done a lot of things on hardboard, and I think when you're starting out, like I think Anurag mentioned, trust and credibility really matters. Knowing what I know now, I would go back and try to change a lot of things. But I think where we did sort of fall short was not really leaning hard into borrowed credibility. I think we were able to identify a particular segment, which for us early on was insurance. We focused and we went really deep on the insurance sector in the first couple of years of our existence because, frankly, it was a less crowded space compared to enterprises, and startups serving the lending sector. So the origin around Finarkin has been specifically in the AA ecosystem. We saw the RBI Master Circular in 2017. We thought this was solving a very difficult problem, almost to a point where it'll be an essential commodity. We thought that access to financial data, structured financial data, with explicit consent will become a solved problem, and where would sort of value accrue. I think the answer that we arrived at was that no two enterprises, internal teams within the same organization would want to use that data in the exact same fashion. So let us not package cookie cutter solutions or one size fits all products, but focus on a very flexible data platform wherein structured consented data can be processed in a very customized fashion. And that's I think a step that we took very early on, which allowed us to be very agile and nimble. And I think that worked for us because the ecosystem took its own sweet time to sort of get to maturity. And I still believe that the account aggregator ecosystem, and most DPIs for that matter, have an incentive problem. I think the bankers in the room would agree that there is a cost to serve data on these DPIs today. And naturally, the expectation on the other side is that the quality of data, uptime, success, metrics, usability around the data have to be up to the mark. But naturally, for the largest banks, there is a cost to serve financial data, and the underlying infrastructure was never built for external to bank scale, frankly, right? So I think some of these challenges or nuances still exist in the ecosystem which need to get addressed. Having said all of that, I think the white spaces that you've mentioned, I think they very much do exist. We have realized that there are different personas within enterprises who are very keen to understand how the economy is operating at scale, for instance, right? So I was talking to a chief economist at a large global bank which has a very small presence in the Indian market. They are very keen to understand the open finance experiment in India is being done at an unprecedented scale. There's no existing playbook in any other global market. So, are there, scenarios or simulations where they are able to understand how the Indian economy is operating at scale on synthetic or anonymized data sets? And are there opportunities to run very specific modeling with respect to not just risk but also product and where they want to go in on. So I think some of these things are still out there for companies like us to co-create with the right banks and fintechs, of course. And I think the one bit that I will also touch on, which I think you mentioned, was what have been our sort of failures and what we could have done better. Definitely, I think I think we didn't realize how much of enterprise B2B sales is also about brand. It's also about trust. We were always tech folks who thought that we would have the best platform and the best technology, and we would be able to sell on the basis of that. I think that has not really worked out. It is equally about talking what you're building and just getting the word out. So that's something that we've been working our way towards now. And looking back now, it's a very heartening moment that every panel that usually happens at these trade shows, a couple of people are our customers today on every panel. So not all, but we'll get there.
I mean, all the best, but you must note that they're actually noting every word you say. It's going to find itself into the next agreement that you're going to sign. So I think before we throw it open to the audience for questions in the interest of time, I just have an observation to make, and then I also know who I'm going to ask what question. I'm deliberately, it's like almost like match fixing, knowing all of you. In fintech, generally people crib whenever RBI comes with a new regulatory circular. The usual crib is, oh, they're being tough on tech company, we are fintech. And I always tell them that in RBI's world, if you're fin or tech, you're fin. That's all. The tech doesn't exist. If you're fin or tech, because you're part of a larger regulated ecosystem which is interconnected, and simply because this entire sector is about pricing the risk. That's your core business. That's about it. You can do whatever you want, but you're pricing the risk. So from that perspective, so the first question to Satyam, I think what is one structural barrier, be it policy, regulation, data, or even market behavior, that you think we must solve collectively as an industry for the next stage of digital lending?
I think the supply side is a critical constraint, and I think that's somewhere all of us are struggling because the secondary markets have not yet evolved. Okay, and you are heavily dependent on the banking system to mobilize, and the whole banking system is again directed by one super godfather. So in the sense that it's a one view, and most of the time the view is prepared after 2 or 3 years of what goes wrong in the system. So your views are in a digital world, your views could be slightly dated, okay, as against it's in the moment kind of a decision making. So solving on that kind of a constraint is very important, and that's for everyone, because the pricing barrier or the right cost of capital, even if we are deploying it for a business or we are deploying it for economy or anything, that's a detrimental for the business.
Okay. Anurag, what is one next frontier you believe we are underestimating? Because if we speak about risk, risks always blow up when we underestimate it and we don't forecast it on time. So as an industry, when we speak about digital lending, what is that you believe we are underestimating?
No, I think just speaking about Satyam was saying, I think the liability side of the balance sheet is still fairly concentrated, and regulator is trying to diversify. If you notice in last 2 years, the kind of like borrowing NBFC world is doing beyond banks is very large. They're trying to create the secondary side of the market. We're also trying to see a lot of global capital coming on the debt side. The equity side has been fairly, I would say, robust over the last 30 years, right? From FI to FDI, all the money has come. But the debt side capital is now coming in. And I would say even in domestically, if you look at the growth in mutual funds versus growth in deposits, I'm like, I was a banker for 15 years, and CD ratio was like the ratio everybody will look after, of course, after CASA ratio. But now CD ratios are changing because banks are borrowing a lot from markets because the money is going there. I'm like, the scale of mutual fund deposit 30% per annum, while deposits are growing at 10, 11%. In next 3, 4 years, compounding will catch up. So I think if one thing which we are underestimating is the liability side of it. We are seeing some respite also coming in. You know, the wholesale credit, which was sitting on banks' balance sheet, is going down because large corporates are accessing credit directly in the market in India or globally. So that might release some balance sheet which will be available for retail. But I'm like, that's one thing at a structural level one has to work about it. One has
So
to think
depth of
about
the
it.
market, you're worried about
Yes,
structure.
the liability side. The liability side.
So, Nikhil, let me come to you. Something I think we should touch upon what you spoke about the hardware side of it or the technological side of it. I think what are the possibilities? I mean, with AI, I think it's also, if I look at corporate India, almost some of you will be listed soon. Some of you are already listed here. The reality is we also play to the optics of what I call the quarterly flavor of the season. Look at, and this is exercise I did. So if any of the students want to do it, actually pick up the annual reports which are digitally available and run it through your AI engine. How many times a keyword, the CEO says that keyword is what you know that is driving valuation for his own ESOP. And I did that for a couple of sectors. And very interestingly, if you looked at 15 years ago, especially after the GFC, global financial crisis, strategy was the keyword that was repeated by almost everybody, strategy and risk. And then over a point in time came technology, and suddenly the technology got replaced by digital. And with COVID, even people who did not understand English understood resilience as the keyword. Because everybody said resilience, bouncing back, correct? And then became ESG. And the last 1.5 years, thanks to one single person, OpenAI, we all know AI. Correct? We all have been saying AI, but considering the fact that this industry has been, banking, BFSI has been using AI for 40, 50 years or more. And this is a sector which has been in development for 70 years. So the question is, how much of bet would you take on AI, considering that if you have to bet your capital that you have, where would you put the money today, structurally? And this is not, I'm not asking for a company presentation. I'm asking for as a bet on the industry.
No, fair. I think the bet remains consistent. It's the bet we took about 6 years back when we started, which was around data privacy and security. I think we were the first ones to talk about things like MPC, so multi-party compute or federated learning. This was way back when Samati had done an hackathon. That was literally the presentation we made, which is still on YouTube. And unfortunately, the tech infra or the compute cost to bake in some of these privacy enhancing techniques adds a premium to the solution. So we are never able to really effectively commercialize it. We kept hearing that there's going to be a DPDPA coming, sometime in the future. I'm glad it's here, and maybe now we'll be right. So I think to do great AI, you need great data, and to have access to great data, you really need these guardrails in place. And we've been investing and building these out on our platform for the last 6 years. So that's what we'll continue to double down on.
Thank you. Akshay, the last question from me before we go to the audience. One important moat, considering that as a founder, you've seen ups and downs and cycles, and you've seen regulations come and go, change, the severity of it. Which is one important moat that you would never sacrifice? Capital versus human capital versus regulatory capital, considering your regulated businesses, versus reputational capital.
Toughest question.
Capital, human capital, regulatory capital, and reputational capital.
See, I would say reputation capital is something that you cannot ever let go of. Right? Once in financial services you do something which is not good, you're done for life. On the other hand, once you have built a consistency of doing something better, you're always looked at that entity, oh, how will they approach the problem? I'll give a very good use case, right? We saw our industry last year, same time, was going through a huge flux of saying, there's something wrong in everyone, right? And we were worried that we should not get portrayed as one of those players who's getting questioned on their business model or being expensive. Now, to our delight, we were very interestingly having a very good discussion. It was with people who do influence regulation and people who convey to regulators who are the good boys and the bad boys. And for some reason, we were on one extreme left corner saying, who are the good boys who don't charge too much? And the one company stands here, all the others are like here. And a nice box was in front of us. We're sitting in the room and saying, it is so good to have a reputation built in of the right boys, right? So you can raise capital, you can get licenses, you can do new to business things, right? But if you do something wrong on your own reputation, you're gone for life.
Okay. On that note, we'll now open it to the audience. And I must also make a kind of a self-deprecating comment on us. When he said boys, we are a group of boys sitting here. So we are a manel, what we call as panel of men as manel. And we apologize for that. This is an industry which has enough women leaders, and I think the subsequent events and the industry events that we have, we must have women leaders in the panel and in the discussions, not as affirmative action, not to balance it out. It's just that they are also equally leading organizations and teams and functions. So I think our apologies collectively on this. So any questions? Can somebody get them a mic? 1 minute.
At this juncture, we are at the crossroads where the new frontiers in the digital lending means like the fintech industry has new avenues to grow their potential customer base by tapping into, the unpenetrated social classes or geographies. But at the same time, the regulator by nature being conservative, they have a fear of credit asset bubbles also. So is there an amicable solution to this conundrum where at one side industry is seeking unorganized customer base and where regulator by nature they don't want?
So I would say our industry is actually not plagued by demand or the regulator mindset. It's actually plagued by the lack of capital availability. Right? You want to grow at 200%, it's not easy. You don't get enough liquidity in the market. Right? It's a supply-driven market which is consciously has to be looked at. At the same time, see, there is a large segment of India to be catered to. If you look at India, we talk about 140 crore people. When we talk about customers who have been catered today by banks, we talk about the first 5 crores. We talk about the opportunity where payments are meaningful and yet transactions are possible, and a number goes to 18 crore, which means 18 minus 5 is the audience available where credit could be populated in a digital atmosphere. That's a very large India, right? Just as a comparison, that's more than the entire banked population of America. Right. Now, this is the opportunity that we have served and the opportunity to serve. But at the same time, there is not that much of credit supply available. While we talk about China and what happened there and the issue with the regulator pointed out, that was a very interesting market. The Chinese never allowed foreign banks to operate in their soil, right? They brought in new ways of lending and credit supply to their market by controlling and building the internal ecosystem. Right. India, that is the big stretch which there is going to be, that there is lack of supply available to build the capability of providing credit, right? It has to be grown in-house. The markets have to get built for it, right? And as the markets get more and more built, you'll find more availability of credit across the length and the entry country opening up. So the next opening up is from 5 to 18 crore. That's the next big base to open up.
Hello, sir. My name is Pranay Jadhav. I ask you question in
Louder.
Hindi. I'm comfortable Hindi. You last 5 years working on instant loan. industry, there are bad debts. How to reduce bad debts? Your experience.
I'll repeat your question so I heard it correctly. I'll repeat it. As a category, we built instant loan, right? And how do you reduce the bad debt in the category? Correct? A very good question. I think the invention of the word instant was the only thing added by fintechs, right? Loans were always similar. There's no rocket science. It's like agriculture was the first business mankind invented. Second was giving loans, right? The question is, we added the word instant because we wanted to showcase impatience coming in the market. Because when delivery of a product can happen in 8 minutes by at least 4 apps in the market, why can't loans be delivered as fast as that? So that's why we added the word instant. It was only to make banks look slower. When you put two lines next to each other, bigger line, the other guy looks smaller than you. There's nothing else happening there, right? You're giving the same line as a product. Now, how do you manage risk better? And this has been the biggest evolution, right? In our previous panel, we heard one very nice line which said they've invested in a 90-member machine learning team or data scientists to really improve their systems, right? A large bank invests in just 90 people, right? A small fintech invests in at least 50 people doing similar job of risk management, right? So first is democratization of the capability of solving for risk can be done by 50 or 90 people, not by thousands, right? Which has been the largest differentiator, that the ability for what you call an instant loan to manage risk better, efficiently is possible. The second part is the concept of ritualization, and I think the fintechs in India followed many fintechs which happened to acquire banks in, let's say, other countries, of building this ritualization concept, which means you will rebuild, redestroy the risk management practice continuously. Usually, a traditional institution will build their risk understanding for a 3 to 7 year horizon. The new age, what you call instant loan providers, move to a 6 months to a 1 year horizon, which means what the traditional guides were learning in 5 years, they were learning in 6 months, right? You don't have to be a 50-year-old institution to manage risk better. You can be a 5-year-old institution, have the similar firepower to keep improving 10 times. That's why if you see, while fintechs were forced to reduce rates, right, their profitability has been continuously growing, right? And that is the single reason coming from this ritualization concept of managing risk more efficiently, building on the concept of redoing your risk more efficiently every year.
Thank you. I'm going to now request that we carry this over lunch. I think any food for thought has to happen over food now. So thank you to my panelists and thank you for the audience.
Thank you, Srinath.
A very big thank you. I now request a huge round of applause from the audience. I now request our students in charge, Ms. Biborni Dawn and Ms. Vanshika Jain, to present mementos to our panelists and moderator. So, Ms. Biborni Dawn, I would request you to present the memento to Mr. Srinath Sridharan, our moderator. members.
Good afternoon, everyone. Welcome back again. I hope lunch was refreshing and scrumptious. And yes, I know the real challenge now is staying up. Don't worry, our next keynote will do the job. We now begin the second half of our seminar with a keynote on digital lending platforms, experience, challenges, and the road ahead. To address this, I welcome Ms. Sugan Saxena, CEO of FACE Fintech Association for Consumer Empowerment, a leader with over 2 decades of experience across fintech, financial inclusion, and policy, who heads India's RBI recognized self-regulatory organization and has played a key role in strengthening industry standards, customer protection, and credit information framework. At MFIN, she played a pivotal role in building the Microfinance Credit Bureau and strengthening industry-wide standards. An alumnus of London School of Economics, she brings both deep expertise and a global perspective to digital lending ecosystem. Ma'am, please grace the stage with your presence. Also, may I please request Mr. Akshay Malhotra, CEO of Fibe, to felicitate ma'am with a bouquet of flowers.
Nikhil can get.
Yes.
Hello and good afternoon to you all. I hope you had good lunch, and thank you again to all of you for taking time for the full day and be here. We really appreciate this. And of course, to our Ravi sir, I really appreciate your vision and opportunity to collaborate with the industry. It's not very common when as industry or as industry body we collaborate with the academic institution. I think this is a missing link which we see in many industries. So thinking about that collaboration and how we can work together is really critical. And coming to a place like where Gandhiji perhaps got his epiphany is especially for me it's very emotional because I think he's my favorite person. So that way it's very good. So thank you so much for that. And from our perspective, this research body collaboration is particularly critical because we believe that as a self-regulatory organization, evidence and data is core to us. We do feel that as an academic institution and the faculty here, you will challenge us, you will tell us what is working and what is not working. And you will show us the mirror that, there are things which are not going wrong. And we really look forward to working with you. And I guess this is just the beginning and we will have more initiative coming down the line. So thank you so much for that. Since we are a very different kind of animal, I guess people know regulator, people know government, people know companies. SRO is something which is very new animal. Even in Indian context, it's not even 10-year-old. I was part of the first SRO, which is MFIN. So I know it looks like an oxymoron, right? How can you be a self-regulator? So a lot of people say that self and regulation do not go together. And then in our name, we have Fintech Association and Consumer Empowerment. Again, it looks like very divergent thing. Can fintechs come together or industry come together for the consumer empowerment? But that's a delicate balance that we have to do. So we are an industry body. We convene fintech companies in India across different spaces, lending, payment, P2P, account aggregators, tech fins, and so many others. We are the largest one at this point, covering close to 300 fintech companies. And last year, we also got RBI recognition as an SRO. So we are the first SRO in the sector. And which essentially means that we have a unique responsibility of being the cheerleaders for the industry. So we champion and we voice the industry, but we also have a unique position to monitor the industry. I feel like very home in this industry, like a mother. So you have to keep motivating your children, but at the same time, you have to, stay firm when they are not doing something wrong. So I think it's that kind of role one has to play. And the whole idea is that we all, as a group, members come together as a platform. They tell us what their problem is. So trust is very important. We take pride in ensuring that we have a very open system. We talk about open standards, but I think open culture is equally important. If we do not have that, things become very opaque and it's not good for any industry. And as a group, work very closely with regulator and government authorities. Fintech is a very complex ecosystem from a policy standpoint. RBI, of course, is main regulator, but we have, MeitY, IFOC, and so many others which fall in the place. So we work very closely with them. We are a conduit of information between industry to regulator and vice versa. Second thing which is very close to our heart is really, self-regulation. So we put standards for the industry and we also monitor and enforce them. So that's a very big part of our work. And as I said, research and knowledge is very critical. People come to us because they want to know what is happening and directly from a regulator rather than just reading the media story, which can be misleading or hearsay. So I think there we have a very important role to have a right kind of information, giving back to industry. And as part of it, we also have a responsibility to see where the global development is heading. So while we as a country are leading, but there is so much happening in other regions. So it's important that we do not remain sort of complacent about or sitting on our laurels. I think we have to constantly learn what other countries are doing. And this is what, sort of help us in decision making. And finally, as our name says, consumer protection is, or consumer empowerment is our core. What it means is that is our North Star. So I think as a group, as a community, whenever we take a decision and perhaps there is a divergence about the views, we think, okay, is this something which will help consumer? So I remember I used to be part of one FMCG group, and they used to have a product line for the food, sort of food product. So I was part of the ITC. And they said whether she will like it or not. So whenever the packaging and whenever the something is there. So that was something which I think keeps us right on the direction that this is something which we will know. So in today's sort of session, I think in the earlier two, we have talked a lot about the sectoral level issues. We have talked about regulation. We have talked about, so to speak, innovation and technology. I think what I wanted to do in my sort of theme is really talk from the consumer perspective. Okay, what is it that we are trying to do? So, my topic today is digital lending platform. What are the challenges, lesson learns, and road ahead. Just, I guess there are many students. I don't know how many of you have ever used a digital lending platform. If you can raise your hand. Oh, so bad. Ashish, there's only one. Okay. So, yeah. So, just, I think I find this sort of magical, right? The platform economy or the digital economy, I find it very liberating. As a individual, I go to different places. I live in different cities. It is my phone which carries me along, finding everything that I need about information, weather, shopping, last minute things which I would have missed, taking cab and being safe. And I guess this is the sort of a thing which is changing economy. And just as we can get everything on my phone, why can't I have financial product in same way? I think this was the genesis of this industry. And I think people are very right to expect that if I can get other products in this way, why not financial services? Why I have to go and deal with a financial institution in my neighborhood, which is not the best institution for me, but I have no other option without that but to deal with this institution, and this institution may not be offering the right product for me. So as we say, I think it's a digital word which has made geography a history. So I think geography is no longer important, and across the Across the world, we have seen that people are using digital means in whatever ways, in a very broad sense. I'm thinking not just in the financial services team, are using this for different things. But as a group, right, while we think something such as WhatsApp, which we all love, how simple it is, how beautiful that product is, and similarly, a app of some of our members, when I use them, it's magical, right? Because you just go there and you do things done, and 2 minutes things are done. But I think a lot of time people think that it's convenient, it's easy, and therefore it's not, processes are lacking, which is not true. So first myth, I think, which we need to bust as a group is, while things look very simple, in the behind, there's a very, very complex system running in the fintech industry, which includes data, which include compliances, which include technology, which include processes, and hardware, software, and so many things, which makes things, which come together and make things something which is looking very simple. So a lot of time we try to undermine what is looking simple, and because it's not complex, we think it's frivolous. It's not. It's very powerful, and I invite students to go and see these fintech apps and see these fintech companies, that how strongly these companies are being built. Second thing, I think, it's important that in the morning somebody was saying that it's not the digital lenders who created the market, it's maybe the social influence or the psychology which created the market. And I want to touch upon this because digital lending has not come out of a vacuum, right? It has not dropped from the sky. There is a very profound changes which are going in the Indian economy, in the Indian society, in the Indian demographic, which means that digital is very critical. If you think about it, and we are in a college which talks about both political science, ecology, you have faculty, which is cross-cutting. It's important for us to realize that it is these, other peripheral changes which actually create a demand for anything. So if you look at credit market, just not too long ago, 15 years back, we still remain very underpenetrated market, but it was abysmal, right? People simply have no access to credit. Either you are very rich or privileged, so you will have banks catering to, or you are a very poor or microfinance phenomenal access that we had, so you have that kind of. And we always used to talk about this problem of missing middle, right? Who do not have, like typical middle class, who will perhaps be excluded from the narrative and from other things. And and you will see a lot of young people, they would not take microfinance kind of a loan where you have to come in a group, sit in a meeting, go to the branches, and so on. This is not their style of living, and therefore it was important. It was a very ripe condition, I feel, for digital to really take off. You had you had a demographic which was changing very fast, so they wanted fast loan. They were having smartphones, they were having cheap data. They were aspirational. So at a behavior level, we saw that, somebody like me who got her first loan when I was buying my house, or I took my first insurance when I had my children. But today things are changed, right? Very early on, very young stage, people start taking financial product. So and then people want to enjoy things, right? I took my first flight when I got my first salary. So today things are different. People want to experience things. So I think this combination of aspiration, technology, data, they all come together, as they say, like a good recipe, and then digital lending happened. And then, we have founders here, we have entrepreneurs who really believe and who saw this pain in the, lives of young Indians, where the old system or the traditional system was not able to serve. And they said that, okay, let's solve for this. So it's a very young industry, and just 10 years old. So like any young industry, it has its ups and downs. So I'll come to that. But of course, we have talked about regulatory development. I think all the backbone which was there in terms of DPI, Aadhaar, and everything, we all are extremely, sort of grateful for what we had, because it allowed us to really focus on the product and the customer experience. And Also, I think too, blessing in disguise, demonetization and COVID really accelerated the thing. So what otherwise would have taken perhaps more years happened in maybe 2 3 years. So I think that was very important event which changed the whole dynamics. So with all these things, I think it gives wind to fintechs, and digital lending, as we speak today, is a very massive industry. Just to give you a sense of things, out of um, you know s- loans, 10 loans which are given to as a personal loan, unsecured loans to the market, 8 asked by fintech and BFCs. So this is a massive change which has happened. We have more than 300 digital lending apps, which CGM DOR spoke about. We are giving more than 10 crore loans on an annual basis, which is a huge number. And more importantly, something which is started as a personal loan or unsecured loan is now really disrupting the other segments. So whether you look at gold loans, whether you look at loan against property, home loans, we are increasingly seeing the back office becoming extremely digital. And it's only a matter of day. There is a saying that, nobody can stop an idea whose time has come. So I think time has come and is here. And I think even this, we would not need digital as a word separately. I think in very soon everything will become digital. I mean, we are literally in a digital age. And more importantly, I think what digital lenders are able to do is again a myth that it's all urban and it's all upwardly mobile people. That is not true. 2/3 of loans which our members give, it goes to tier 2 and tier 3 cities. Loans can be as low as less than 5,000 rupees to go up to 5 lakhs rupees. On the SME side, they range from 50,000 to 2 crore rupees. Loans are 24/7. When life is 24/7, why should financial services should be 9 to 5? So they operate 24/7. You can take any time you want. You can take any loan, right? The biggest problem in the traditional thing is that you can only get 30,000 rupees. You can do it for 2 years. I don't need it. I needed 3,000 rupees now because my fuel is running low and I have a trip to complete. And this is where fintechs come in to say that we could be very customer centric. I always say that I come from microfinance, and we saw that while it's a very, great product and everything, but people really has to struggle to get that loan. They will sit for hours in a branch office, they will come to places and then do it. And there was something about the customer protection, but I always like the word customer delight, right? So I saw this word, our members is speaking that, we want to make this whole experience so good that finance is to be very embedded in the daily to day life. So finance is something which should not be that you do in the bank, that you do the only the rich people can do. It's something which is very much part of your life. So that is something which fintechs have been able to do. Again, the myth is that a lot of these loans are going for wrong reasons, which is again entirely myth to be busted. People are intelligent, people are adult, and when they come from mid and low income people, they are actually very conscious. Which essentially means that majority of these loans go for very real needs, which includes travel, which includes emergency, which includes education, which include daily very needs. And we cannot wish away that, for large section of our people, which is 80% of people, are actually very vulnerable. And in a country where the insurance is not there, in a country where there's no social security, where there is hardly any saving, it is a loan which helps them navigate their financial lives. So they are very, very critical in our context. So, so as of course, I did my first part. This was my first part, which is championing the industry. But as I said, it's still a very short journey. And just like any young person who's 10-year-old, you don't think of the risk, right? You are learning things. You have a zest for it. And therefore, while there have been a lot of ups, there have been downs. First, something which we spoke a lot about is, the sheer success of digital lending we saw so many unauthorized lending apps coming to the market. This was the biggest thing where Face was very much involved, where we saw hundreds of apps coming on the Play Store and giving loans. It created huge dent on the image of the industry, which we are still dealing with. It's still not yet over, but thanks to the action by the RBI, Play Stores, Enforcement Agency, we are almost solving the problem. RBI, as Mr. Babha was saying, has a list now, and very soon, just in few months away, Google will only allow apps which are part of the store. So I think as a group, we are able to solve this problem to a large extent. Second thing is, I think it comes in the terms of risk, right? So when you are driving a cycle and then you suddenly switch to a bike or a car or the Formula One, each comes with its own set of risks. And somewhere, if you use the same rules and same safeguards which you must be using for your bike, will not work for a vehicle which is running at a different speed. So whether they were legit players or unauthorized player, I think there were a lot of gaps when it comes to customer protection. So we saw that the transparency was not up to the mark. There was no consent for data. There were a lot of gaps. There was data was taken without customer knowing what is happening. There were challenges in terms of compliances, partnership. I think today each partnership takes some. Nikhil was telling me that it took them longest to have a deal with Five. It was almost comparable to ICICI. So this was not something which used to happen a few years ago, but things are changing. And fund flows, recovery practices, all those things, right? So I think things are changing. So, but at that point, I think when you start industry, it is inevitable. I mean, this is part of. The other thing, I think, something which again RBI spoke about, and I think I just want to again re-emphasize that financial services are very unique from other products. Whether anything going wrong with the financial product means it can have very wrong consequences for the. So while there is a literature which say that customer is adult and they take the responsibility of their decision, in case of financial product, there is equal responsibility on the provider to take that responsibility. This thing that customer will choose and as per their decision does not right work, because there's a lot of information asymmetry in terms of financial product, or anything going wrong is very significant. Second thing which we saw was really perhaps a under appreciation and of the risk which are there in the digital lending, the sheer nature of the speed, the sheer use of technology, the scale means that lot of risk with respect to fraud, third party integration, cybersecurity and data protection, and were somehow overlooked. In last 3 years since digital lending guidelines have come, I think a lot of these gaps have been sort of addressed, and we are at a much stronger footing. Third thing, I think, which is very critical for us as a community, and while the first two which I talked about are somehow guessed through regulatory issues, is the impact part, right? So while in a zest to provide access, what we are somehow lacking is, are we making these consumer better off by providing this credit? So there, I think, it's important that, we realize that many of our customers are in the range of earning maybe 30,000, 50,000, 40,000. And if you are having this kind of income and you have a family to run, maybe extended family back home, it's not an easy life. It's a very hard life. And any small event, any changes in the macro condition, any health emergency is really, keeps you vulnerable. So there's no issue of intent as such, but it's just their lives are so vulnerable that, things happen and it can have impact on the society. So as a group, I think it's important for us to ensure that, we sort of handhold our customer and see that, they choose the right product and choose the right decision for themselves. So I think there's much more which has to go there. So today, as we embarked on the next decade of digital lending, The success metrics for the last year, which was growth, maybe access, convenience, 2 minute, 1 minute, 30 second, they are no longer good. Just as we grow in our lives, every decade has its own success metrics. So for this decade, I want to talk about four, which I think are very important. In terms of inclusion, of course, we have done a great job of reaching many places, tier 2, tier 3, and so on. But there is a vast community which is left behind. 85% of our loan go to men, and 15%, just 15% to women. So there's a much more which has to be done to bring women into the fold. Rural remains completely off the grid, and so is not to savvy. So while we are catering to very young population, 2/3 of loan go to people in the less than 35 years of age. But if at all we have to expand the pie, we have to be much larger. It's important we do not overburden the segment that we are serving with, but really expand to other segments. And it's important to really, in that case, have a partnership, because a lot of these people would not be DIY customer. They will not be able to navigate the journey on their own. And therefore, those phygital partnership will become very critical. Second is really the impact. This as so much, so far you can go by saying that, we are providing credit and all that. The impact is something which as an industry we have to prove and show. And we have to challenge and question what impact we are creating, and which has to be evidence-based. So as we know, price shock, employment, trade wars, climate emergencies are becoming more and more common. And the risk is something which is not something which comes once in a while, And therefore, you had this insurance product because it used to deal with the risk in a way which comes once in a while. Now the risk definition is completely changed, and we are talking about a risk which is everyday risk. And therefore, what do we need to do to ensure that these customers remain resilient and shock-proof is very important. And really, taking much more responsibility to ensure that customers, take loans, are able to repay is more important. Third, again, innovation. This is something where fintech industry feels that, this is something which is only their privilege, which is not. Nothing is for granted. There are incumbent, we saw in the first panel about the banks, the kind of innovation they are doing. And therefore, it's important for us to really step up on the innovation side as well. And it will continue to happen across product, service, quality. As a group, I think we are very excited about the AI. So much so that, we were limited in terms of our customer segment because everything was in English. The kind of capability AI provides us in terms of bringing efficiency, in terms of bringing language, in terms of bringing unstructured data is immense. And we feel that, AI would really give, wings to this industry to go much deeper. Third point is really the integration bit, right? As an industry, we are just part of a larger context with whole financial, economic, and social context, and really linkages to the real and the real sector economic value change. So as an industry, financial services is unique that it does not really create any product or services, but it really enables all of them. So as we go deeper in the financial services, it would be important for us to be much more deeply integrated with those value chains, those supply chains, those real sector, and see whether we can solve for those problems. So integration, not at a consumer level, but at a much deeper level with digital economy, with real sector, with household, with supply chain, with cross-border would be very critical for us. So to sum up, so we feel that we have a very critical role to play as we aspire to become a stronger nation and more developed one. And we are very, very blessed to have a very strong regulator and a supportive one. We have a huge, huge political goodwill. We have champions in the political leadership, which are promoting fintech, not just in India, but abroad. Digital lending direction in last year have shaped the industry to maturity, bringing customer protection and compliance, risk management, and governance to the front. Industry is growing, industry is diversifying, scaling in a responsible manner. We are, as an SRO, are thankful for the trust that regulator has placed in us, so that we are, keeping pace with the speed. We know the risk and opportunity early enough and work collectively to address them. As a community, we look forward to working with all the stakeholders in tapping the industry potential to the fullest. So that's all for me, and thank you so much. In case anybody has any question, I'm happy to take it. Thank you. Thank you.
Thank you, Ms. Saxena, for delivering the keynote address. It was truly insightful, and I'm sure everybody here will have much to gain from this. Can we have another round of applause for her? Thank you. I now request Mr. Nikhil Korhe, the CEO of Finarkin, to present her with the memento. I now request the student in charge to present her with the memento. Thank you. We shall now begin panel discussion 3, which focuses on the digital credit ecosystem, the experiences so far, the challenges that remain, and the road ahead as India moves deeper into open finance, account aggregation, AI-driven customer engagement, and fintech regulation. I'd like to invite on stage our panelists and moderator, Mr. Vivek Belgavi, Partner PwC, Mr. Vamsi Madhav, CEO, Finvu, Mr. Ganesh Gopalan, CEO, Gyani.ai, and Mr. Prashant Ramdas, Partner, Khaitan & Co. May I request the volunteers to please present bouquets to Mr. Vivek Belgavi, the moderator, Pranjal. May I request our volunteer Siri to present the bouquet to Mr. Vamsi Madhav. May I request Pranjal to present the bouquet to Mr. Ramdas. I request Siri to present the bouquet to Mr. Gopalan. Thank you. Now let me introduce you to our panel. Our moderator, Mr. Vivek Belgavi, is Partner and Financial Services Advisory Leader at PwC India, working at the intersection of technology, innovation, and policy. An alumnus of IIM Calcutta, he has played a key role in national level initiatives on digital financial services, fintech regulatory strategy, and emergent technology adoption across India's BFSI ecosystem. Can we have a round of applause for Mr. Belgavi? Mr. Vamsi Madhav, CEO of Finvu Account Aggregator. He has been steering the company since mid-2024 towards becoming one of India's most trusted account aggregators. He's a veteran in fintech with over 2 decades of experience. He has previously served as COO at Sahamati Foundation and Senior Vice President at Mahindra Comviva. He has an MBA from IIM Lucknow and has contributed significantly to open banking standards and secured data frameworks in India. Can we have a round of applause for Mr. Madhav? Our next panelist is Mr. Prashant Ramdas. He's a partner at Khaitan & Co. and brings more than 12 years of experience in banking and finance, fintech, regulatory advisory, and data protection. He works extensively with digital lending, payments, wealth tech, insurtech, crypto, and digital asset clients. His expertise spans licensing, regulatory approvals, compliance reviews, and product structuring for BFSI organizations. Can we have a round of applause for Mr. Ramdas? Our final panelist is Mr. Ganesh Gopalan, CEO and co-founder of Nyani.ai. He leads one of India's foremost agentic AI and voice automation companies, which is backed by Samsung Ventures and InfoEdge. His platform integrates speech-to-speech LLMs, multilingual SLMs, and omni-channel automation to transform customer experience for over 200 enterprises globally. Under his leadership, BFSI clients have seen 30 to 40% cost savings and strong improvements in customer lifetime value and agent performance. A huge round of applause for Mr. Gopalan. With that, I request Mr. Belgavi to take the discussion forward as the moderator.
Thank you so much. Thank you so much for having all of us here. I was just reflecting that it's a very interesting audience we have. We have got ex-regulators, we've got fellow practitioners, and we have students. So as we have this conversation, I think it will probably have to hit all the right notes for us to make it interesting. What we're going to chat today about is India's digital credit rails, and specifically the role AI can play into it. So I couldn't ask for a better panelists to start talking through it. But as we get into it, I was just reflecting on this topic with regard to my trip to US around 2 weeks back. And there was a debate happening there on stable coins. And I asked a question. So we had people in the room who were running the stablecoin infrastructure. We had people from Citibank, Circle, which runs USD, and we had that ecosystem there. And asking them the question as to how do they see stable coins and CBDC coexisting. The answer surprised me, and I thought it's a good context to this. They didn't see a relevance of CBDC at all. Right? And I was thinking, why is that? And I was having a chat with a few of the colleagues. The way the US market has evolved, and it is not generally the financial services market, but broader market, there's such a heavy emphasis on privatization. It's where the country stands. That for them, a stable coin or private-led enterprise, which is where Bitcoin also has got some traction, has got a lot of currency out there. But when we talk about India and the way we have evolved and the way we have got the layering of all income classes, all demographics, and so on and so forth, here for us something like a CBDC is quite important. Right? So I think that was a good context to start thinking through this topic. In a country like ours, where there is such almost we say inclusion, right? So the reason we say inclusion is the way financial services can be delivered to the last mile will not be as profitable as servicing it to probably the first mile, right? So, and it's very difficult for that economic barrier, just from a pure business and commercial perspective to transcend. And that's where a digital rail here becomes almost a necessity for creating a level playing field, which allows for low-cost financial services to be delivered to the last mile, and of course, value-added services to be built up with customers who can pay. Right? So I thought I'll just simplify the context of why we think digital rails are important. Now, of course, AI can help us in driving a lot of things more effectively through the digital rails, but I couldn't have asked for a better panelist. I thought with that background, probably I'll jump into it, and Vamsi, probably I'll start with you. Account aggregators probably completed around 4 odd years. That's right. So where are we here truly, right? So what's the status of affairs? And for the audience, what's the purpose account aggregators are truly solving? And in your mind, what's working, what's not working, and for enabling credit flows, what more needs to be done?
Sure, thanks Vivek, pleasure to be here, and thanks to the organizers. So this happened a month ago. A good anecdote to perhaps sort of answer the question. So I was at the gym. Yeah, this is where you're supposed to clap. You know, it was that's something for. No, I didn't mean that literally, but and you know, the trainer just got talking. Where do you work, etc. I said, "Oh man, I've got to explain account aggregator to him." And then when I started, he caught me mid, sentence. I said, "Oh, you are like this," and I won't name because he named a competitor, and said, "You are like that."
And then I had mixed feelings because I was happy that he knew about account aggregator, not so happy that he wasn't talking about FinView. But it was surprising. And then he said, how come you know about this? And he said, oh, I was applying for a loan and from somewhere, and I saw this, and so I connected the dot. That to me sort of captures where we are. So in 4 years, we've reached a point where the lay borrower in the country who probably doesn't know a lot of what DPI means and what all of this stuff means is experiencing and noticing, but it is still midway there. Generally speaking, there are more instances of citizens who perhaps use this without really understanding a lot of it. So where we are, Vivek, in terms of sheer numbers, on a daily basis today, after 4 years, there are about 15 million data fetches that happen in the ecosystem through the account aggregator rails. Every day, there are roughly about 1 million new consumers who are experiencing an account aggregator flow on a daily basis successfully. On an average, out of 10 consumers who experience it, we generally see, and there's of course a difference in how a borrower experiences it versus, say, an investor experiences it, but essentially about 7 out of 10 people do experience success. So, overall, if you look at it in the 4-year time span, we would probably have reached about 150 million unique individuals that have experienced it, and about 200 million accounts whose data has been shared. So, when you put these numbers out there, it's always a mixed feeling. These numbers are huge compared to anywhere else in the world. But if you look at, for example, to your question, what percentage of lending actually goes through an account aggregator touching the workflow, we are still somewhere about 9 to 10% both by value and volume of personal lending using account aggregator. Business lending, because of various other reasons, is about 3 to 3.5%. So there's a huge opportunity still left, but
this is the percentage of digital lending.
This is the percentage of digital lending. And so I think there's this fair amount of usage, I think, to be squeezed out. In terms of, I would say, the reason why we've touched these 150 million or daily million is because there are about 50 institutions in the country who really use this at scale. Nearly everyone in the country that is of note has plugged into the network. So we've got close to 700, 800 institutions already in the network. So I guess we are at a point where what we see on a day-to-day basis is the narrative being that this is systemically very important, and the advantages are very obvious compared to what existed before in terms of how citizens like us would give our data. But there's still a fair amount of path to go.
Great, perfect, great starting point. Ganesh, bringing you into the conversation, AI agents it's the zeitgeist, right? So it is something which is there, spoken everywhere, and probably a lot of it is understood, misunderstood. So we'll lean on you to clarify a little bit on what's the real state of affairs on AI agents, and if you can connect the dots between AI agents and digital credit rails, what are the interaction points?
Yeah, so I think a good way to explain this would be, let's suppose somebody wanted to start a business, right? Say, even a few years back. The first thing that they would do is go to the HR department, say, I need, 5 people with these skills, right? So I need, X person has certain number of years of experience and has certain number of skills. I need a Y person with a different set of experience and has different set of skills, right? And then the HR department will go and source these people and get that done. I mean, this is oversimplifying it, but currently with AI agents, the promise of this whole AI agents is fundamentally you would now have access to an AI agent that can do a specific task. Again, to draw the same parallel, you could have an AI agent that is trained to behave like a, say, a 2-year experienced person or a 5-year experienced person, right? So essentially now, what really are AI agents, to go back to that, right? AI agents are essentially resources, digital resources that you can count upon, right? Again, in simpler words, now again, take it one step further. AI agents are really your digital workforce, right? So having put that out of the way, right? Essentially, let's suppose you have any sort of process, right? Let's suppose you have underwriting, right? Now the whole process will involve bunch of steps, right? That are done, in the process, right? Let's start with, even before you start underwriting, you're going to do pre-qualification. You're going to find intent, right? Then you will get into various aspects which are routine, which rely on core data, alternate data, and finally you come up with bureau, and finally you come up with saying, look, I want to go ahead with this person to give a loan or not, right? Now, if you look at it, once you start breaking it down, you will have multiple agents, right? Look at it as one task, right? So you will have AI agents now who can do multiple set of tasks, right? And then just like, in any office, or, any school, you will have, a supervisor, right? So similarly here in AI agents, you will have a supervisor agent, right? In a multi-agent framework to make sure that all these tasks are done properly and in the right sequence and data is shared from one task to the other, right? Now, so now I have clarified what an AI agent is. Essentially, it's your digital workforce, right? Today, if you want something done, you might hire somebody, but you could really actually go and hire an AI agent, right? But now getting into details on where is the current state of the market, right? So currently, a lot of companies, NBFCs and now a lot of banks starting to use AI agents firstly for what is is of very high volume, right? And what typically is outsourced. So things like, even before you get into underwriting, getting into finding intent, why do I need armies doing routine stuff just to find out whether there's intent, right? Second is pre-qualification, right? If you're having an SME loan, you want to find, how long is the business and all this kind of, what's the turnover, bunch of those things. Can I get access to all that information? If it's a PL, can I get access to, information on, how is he salaried, how long is he salaried, what's his salary, bunch of other things. Now, we have like, for example, voice AI agents today doing this in multiple languages. And the scale is really, really enormous, right? We are really seeing scales of, a few million transactions or a few million conversations on a daily basis, right? But where the stuff becomes more interesting is now when you get into, the core underwriting piece, right? Which I did mention that is divided into, say, 10 to 20 tasks, right? And that is where a lot of companies are now starting to touch. Now, already most companies will have, an ML model, right? It doesn't matter what kind of AI model it is, right? Some model which will help you with your decision making. But companies are just starting to do, the first exercise of dividing the whole process into multiple tasks, getting a platform in order to do that, right? And what it really means is as simple as this, right? Today, if a person is able to underwrite, say, 5 loans a day, with an AI co-pilot assisting him, can he do 20, right? And that's the whole promise, which companies are starting to do, and which is like, an amazing thing that is, really changing the industry. So, yes, what about the core algorithms, the core, you already have ML algorithms. Yes, there is effort happening to see, can I add context? Can I have different kind of sources? Now that, I have GenAI, can I put some sort of RAG into that? How can I make this process even faster? So there is definitely effort done on the core algorithms, But the opportunities, what I'm trying to say here, are more on the other extraneous factors where you are going to automate a lot of the routine processes.
Couldn't agree more. And in my mind, just in terms of context, with this greater productivity, it's not that one would want to push more products in the market, but largely, as we are aware, there is a lot of credit demand is unmet today, and for a variety of reasons. So part of this will help us bridge that gap. Uh, Prashant, really coming to you. So the digital credit trails that we have today, they've already built in certain important safety, safety and responsibility layers such as consent artifacts that is done. For us to scale further, right? So let me, like both Vamshi and Ganesh, what they spoke of are, if I add those two, we can already power our digital rails 5 times, right? Between agents and the AI infrastructure. What other artifacts you think are critical to scale that responsibly?
Right. When it comes to the digital rails in India, I think before I really go into what additional we need to kind of scale it up, I think a few thoughts on the digital infrastructure in India. First, in terms of how India as a country, we are very lucky to have the initial layers of the Jam Trinity, Jandan, Aadhaar Mobile, which has really transformed how financial services really operates in India in the last decade, right? So I think the digital public infrastructure building blocks in India is really used as a example across the world, and the UN last year has also adopted India's model, as a in other developing jurisdictions as well, and given the demographic dividend in India, given our population, given the credit gap which you mentioned earlier, it's very helpful for us to really have that starting boost, to really have those preliminary layers already in place, over which layers like the account aggregator, open banking framework, and AI. Obviously, we discussed how AI is very transformative in terms of being really helping you achieve that scale really quickly with digital agents and digital workforce, etc. Right? So that way, India as a jurisdiction, the regulators, the government have been encouraging use of emerging technologies in a responsible way. The regulators in India have always encouraged use of new technologies, but with prudent guardrails. Regulators always look to ensure that anything which you do does not really adversely affect the ecosystem in India, and customers are not adversely again affected, right? So when it comes to the digital rails today, you have multiple multiple digital rails today, right, from account aggregation ecosystem to the unified lending interface, which was introduced recently. You have OCEN, which is also being developed as a credit marketplace of sorts. You have ONDC, which is all transformed provider network really for e-commerce. So the digital public infrastructure rails have been designed in a manner such that, given India as a jurisdiction, it's imperative for us to really have that open networks over which the market can really build around, right? Going back to your initial comment on how in the US the focus is on privatization, in India it's indeed needs to slightly be different, given the given the nature of the economy, and given also that there's a huge opportunity for all types of businesses to thrive, given the huge gap the market needs to meet as well, right? So from that perspective, it's been really a great journey, I would say, overall, when it comes to digital public infrastructure in India, and specifically in terms of how or where the regulatory gap is. Maybe businesses or market players might find that different systems operating in silos today, there is no interoperability between various systems. One might also argue that it's not clear as to what the liability and accountability gap is tomorrow. For example, if the data which a lender is using to assess a customer is incorrect or inaccurate for whatever reason, given that there are multiple players in the chain, who's really going to be responsible? When you have frameworks, like ONDC, where there are multiple parties involved in the chain and disputes arise, how do you really kind of resolve those disputes amicably? Uh, uh, and also in the context of AI, as we know, issues around, bias, issues around transparency. Regulators have always, even in the context of machine algorithms, regulators have said that you have to have explainability in your credit decisions, etc. So all those kind of factors are still gaps which the regulations need to address in the long run. And yeah, having a clear framework to address some of these issues will help the ecosystem grow in a long way, will help all different types of players also build trust in the ecosystem, so that they can help scale the infrastructure and also build their businesses as well, and scale their businesses for the good of the nation.
Great point, Prashant. Vamshi, probably want to go a little deeper into what you touched upon in your opening remarks on where AI is getting used. So if you get deeper into the use cases, an example you shared, like a personal loan, a digital personal loan journey. But if you can unpeel that a little bit to say, if you take a product view, or maybe let's say a consumer view, kind of different needs that we have,
Yeah.
which needs do you think we have progressed more, and what are the next set of needs that you feel is where the usage of AI will grow?
So the way I look at it is, if I take myself, there's probably three roles that I could sort of be playing from a financial perspective. One is borrower, right? As an individual, when I want to borrow, again there are a wide variety of end-use needs, where AI clearly, very logically, has made a dent. Is if I want a personal loan, as opposed to say a home loan, for example. Uh, Very clearly, my ability to claim that right to have that offer is being, sort of very nicely used by the ecosystem today. So out of, 100 transactions that happen, my guess would be about 60 to 70 of those are fundamentally borrowers like me looking at somebody giving me an unsecured PL. And, that whole sort of discussion around, do I get a loan only because I've already got one before versus I'm a new to credit, etc. I think we're seeing a fair amount of shift in terms of AI being used very effectively there, number one. Number two, the second persona is that I'm a saver or an investor. I want to sort of grow my money. And I think we've seen that sort of become a fairly, it's almost a resurgence of the classic PFM sort of a framing, where people said, oh, we would like to give people a better handle on their financial position. And there's a wide spectrum of use cases there, from just wanting to know how my spends are and getting a better handle on spend analytics at the one end, to sort of having a very easy view of what my, say, net worth is across all my holdings. And I think we are seeing that, while average ticket sizes of credit are going down, the average ticket sizes of investments are also going down. There's more participation. So we see a lot of modern fintech regulated entities wanting to bolt on this as an additional use case. So roughly about 20-25% of the usage today comes from stockbrokers, from banks, from registered investment advisors wanting to offer this to me as an investor. A third category is my role as perhaps an employee in a company. And we are seeing there two kinds of use cases coming up. One is if I work for a company that needs my disclosures, because there's a SEBI compliance that the company has to sort of abide by for insider trading disclosures, etc. I find it easy to give my information using Account Aggregator than call my relatives and ask them to give my info and all of that. And we're seeing use cases like employee contracts where there is a financial need sort of coming in. And I think where we are very excited with the recent DPDP, the not so recent act, but the recent rules that have happened is that suddenly consent-based data sharing, which is sort of the core of that acronym that the government put out called DEPA, Data Empowerment Protection, will now start getting extended to nearly every transaction. So we know cases where my financial sort of profile is part of my sort of trust giving signal. There are cases like matrimonial companies, rent agencies, and so on and so forth, where I have to give that. That's been a little bit of a pipe dream, but we see that within striking distance now, because with DPDP coming in, there's an overarching layer. So we see that all of my day-to-day sort of needs, where I ordinarily would struggle to give somebody some trust signal saying, you know what, you can trust me, I do earn so much money, or the banking relationship is XYZ. I think we'll see some of those sort of use cases coming up, but that's a little futuristic.
Ganesh, a different question for you than what we discussed. Apologies for that, but as you spoke, it came to my mind. We have seen, and many of us have gone through the RBI free AI report. And it's a visionary report in my mind, at least. It really put on the contours of, it has managed how we should look at as we work with AI. How do we really put guardrails around AI that taking safety as a mechanism, transparency as a mechanism, but more importantly in my mind also sovereignty as a mechanism, right? You have built this organization. How have you, just throw some light for the audience on what's the reality of truly a homegrown AI native startup? What does it mean? Like, how do you work on your models? Where do you see still the dependency to the globe? Where do you see indigenization coming in? So, bit of flavor on AI and how does it cater to the direction the regulator is currently providing?
Yeah, I think a lot of very interesting points and very relevant, to the way, firstly, if I can say so, in terms of geopolitics and other things which are, making countries, not just India, but all over the world look at sovereign AI, right? And the first piece I'll pick up there, right? Now, sovereign AI has many components. What does it really mean, right? So essentially, it means that AI is a huge differentiator, and beyond anything, you heard people say it's bigger than the internet, right? So it's beyond anything that we have ever imagined, right? Now, when you look at, so if the internet today is the same internet that you get whether you're in India, whether in the US, or any other part of the world, right? And what the internet really did was, democratized information, right? So it's the same. If I love cricket, so if I go to cricket.org, whether I see it in India, whether I see it in the US, both have the same access, right? But what AI is doing is democratizing intelligence, right? Especially when you start getting into the agentic AIs. But here is where the whole issue is, right? Now, let's suppose there are global models that almost every country has put out, right? Now, in India, we in Gyani are developing our own sovereign AI models. We are one of the shortlisted companies that are doing this. And why has the government really done that, right? The reason is simple. Firstly, from the outs, this is the most biggest piece, right? From a model standpoint or the broader model standpoint, is it, are we going to be dependent on external nations, right? And having this sovereign AI models are going to be extraordinary in making this happen. Having said that, it is also real that all the models that come from outside India are not made for India. So the models are not made for India. So they don't work for Indian languages. They don't work for, in India we have terminologies like IMPS, NEFT. A lot of them don't work for things like that. So firstly, they are not good enough. Secondly, they don't work for our country. Secondly, you're worried about the data, right? Now, that's the third piece, right? So one is the whole model. The second piece is data centers. So that's why the government, and you see, pushing a lot of people to set up data centers within the country. And it's not very particular to India, it's happening all over the world, right? So you're going to have your own AI models, you're going to have your own data centers, so that you're not dependent on anybody for anything, right? And this is really, really extraordinarily important going forward, right? And because it's a very different world from the world that saw the internet coming into play. And that's what we got to realize. Now, within ourselves, what we have fundamentally believed in as a company is, in Gyani.ai, we try, or every component that we use, every AI model we believe has to be homegrown. For the reasons that were mentioned, it also gives you control on the quality of, things like hallucinations, gives you the quality of your outputs. So having a control of each and every element of your AI pipeline is extraordinarily important. I think the day of wrappers to using like global models will be limited to the amount of money they are experts in raising, but it will not last very long, right? So the only way to do well, in this industry is to have your own AI models, and it's also a national, emergency, if I can say so, to have AI models, have your own data centers that will service those models. So there are two parts, right? So when I say data centers, now what's that, right? Now it's like GPUs, right? So today, almost every AI model runs on GPUs, especially the newer, Gen AI kind of models. Now, access to GPUs is becoming a national treasure, and that's the other reason why government is going and talking to companies who make these kind of models, making it easily accessible. There's a national AI mission. MITI is doing a lot of efforts in this regard. So it is a national emergency, not just for India, but for countries all around the world. And to survive, even as a company, you need to look at it from a very sovereign sense, that you need to have control on each and every element of the pipeline. And that's what we go to build. If we do a voice AI agent, we would have our own ASR, it's a speech to text. We would have our own SLM or LLM. And then we would have, some sort of text to speech. But within that, there are multiple models around, a denoiser that you'll have, and several components on how do you handle turn taking. So there will be a lot of niche models that you may have to build, right? It's not all a solved problem, but this is absolutely essential that you own each and every element of that pipeline, right? Taking it one step further, I spoke of national sovereign AI, but we are starting to see a lot of financial institutions looking at sovereign AI for that institution, right? So if I'm a bank, I have a lot of vendors working for me on various things, right? I want to make sure that the AI that I develop, right, is only for my bank, because there is some component, even if you have, for example, a small language model for say a BFSI industry. For example, we have a small 3 billion parameter model for the banking and financial services space. But when you have to really fine-tune that model for your organization, and a lot of companies are saying after fine-tuning, I don't want anybody else to have access to this, right? This is my core data, this is my core wealth, right? So going from, I would say, a model of the internet to be a resource that is freely available, this is moving to a very sovereign model for nations, and moving further to a sovereign model for enterprises. And that's clearly the trend, and I don't think the signals that are coming from industry, this trend is going to change. In fact, it's going to really, really amplify in the future.
Great points. I was reminded, I'm not sure anyone on the panel has seen this movie called Humans in the Loop. Anyone in the audience has seen the movie? Highly, highly recommended. I'm a big movie buff, and probably one of the best movies which has come out of India this year. I'll give you a TLDR, and it's on many levels, it's great. Level 1, a lot of these LLMs, Ganesh, to your point, need training. So it starts with, now this labeling which is done is a big industry which is happening in small towns in India. So it is set up in a small town in Jharkhand, where their team is actually working on labeling, taking a photograph and just labeling it out to say this is a pest, not a pest. All those labels go out. Layer 2, one of the women working there searches for beautiful tribal women, and it just shows up random tribal women from all over the world, and she's saying, why is the beauty that I see around me not coming there? So they started uploading their local Jharkhand photographs there, start labeling, and then you start getting it. So a bit of a sovereign AI pitch, and I had a feeling Ganesh would love talking about it. Prashant, the question for you, which Vamshi touched upon, this growing need for privacy tech and DPDP is fantastic from a consumer point of view as we get educated. But will it come in the way of innovation? Is there a way organizations can balance both, give consumers privacy at the same time, not reduce the pace and the velocity of innovation?
Yeah, no, I think it's definitely a paradox because when it comes to the credit underwriting, for example, lenders would traditionally believe that okay, the more data I have, the better it is for me to understand the customer, underwrite the customer, assess risks, and ensure that my decision is more prudent. But from a consumer standpoint, consumers might not want to disclose so much data to the lenders. They might not, especially when you're using Rails, where you give consent and the lender can, in a matter of minutes, get your bank account statements, essentially get all data relating to your digital footprint. I mean, either through account aggregator Rails or bureau data in terms of credit score, or even alternate, data when it comes to customers who are new to credit and who need to be assessed for granting loans. So sometimes customers might feel that okay, the lenders really have all my data, and is that okay or not, right? And I think the DPDP Act and the rules and the entire framework is a principles-based framework where the idea is that the customers should be in control in terms of where the data is being used. You have a consent-based framework, obviously, where the organizations who collect the data and process the data need to inform the customers as to what data they have, why do they need the data, and ensure that the data is only being used for the purpose for which they disclosed the data is going to be used. And there's also principles, like data minimization, principles like purpose limitation, transparency, accountability, etc. Under the Act, where once the relevant purpose has been fulfilled, you cannot really hold on to the data, use it for other purposes which were not really envisaged when you had collected the consent in the first place. Definitely, when it over the years, the concept of privacy by design is also really important. When organizations look to structure their data protection program, ensuring that their customer journey flows, their workflows, incorporate design elements which by definition ensure that customer data is protected in the first place. Privacy enhancing techniques are also now really kind of coming to the forefront, and in terms of even the consent artifact 2.0, which is shaping up, the idea of really ensuring that various techniques which are available out there, which help protect the customer data, help meet those principles, are really going to be used. And with DPDP coming into force, I feel it's more going to be aligned with I don't think the intent really is to stifle innovation. The intent is to ensure that there is more innovation, but in a manner where data is not misused, in a manner where customers are aware what's happening, and as long as you revise your workflows to incorporate those principles and build it in that manner, then you should be able to really create more innovation and grow more faster with much more scale.
Super. I think that's all. That's how much time we have. Could have continued this conversation a little bit more. But just in case there are any questions which the audience might have, please only questions, no comments. Yeah, thank you. Anyone in the panel wants to pick it up?
Yeah, so the question is, how is OCAN and ONDC, how is it beneficial and how is it picking up? I think broadly what we see and hear, and we do participate in the ONDC network, even the OCAN network, as one of the legs of that entire workflow. I think the idea is essentially fundamentally that if you replace platforms in the center with a protocol, then you are no longer bound by certain entities that control the market in terms of distribution. You can now have manufacturers reaching any distributor, regardless of which niche segment of consumers they are distributing to, and the platform sort of in the middle gets replaced by a protocol. Whether the protocol is called Open Credit Enabled Protocol or whether it's called Open Network for digital commerce with financial services as the product, which is ONDCFS. The central idea is this, that you can effectively agree on, like the internet agrees on the HTTPS protocol, you can agree on a protocol and therefore you can cut out the middleman. Having said that, how is it sort of growing? Like any other sort of system, you need a two-sided thing to come in place. So there's always, who will go first sort of a thing. People want others to join and show that it works. So we are in that phase where the early adopters are seeing a fair amount of, I think, cost reductions for sure. They are also seeing the ability to reach consumer segments that they would not have been interested in simply because they can't reach. So those advantages are there. And there's definitely early signs of good month-on-month growth in all of these. But it's got to come together for a hockey stick to happen.
ONDC, I think you touched upon it, is more on the commerce side of things, less of financial, but they're embedding and as Vamshi mentioned, early stages of adoption. I'll just give a sense of it because we are working with a few of the lenders. So if you think from a lender's perspective, now because of a lot of digitization, let's say GST is getting digitized, commerce is getting digitized, there are many folks who have the data and want to give access to credit to their customers, right? So single lender has now almost 200, 300 partnerships. Now, there is no one protocol for that partnership, right? So it's imagine we are having 100 different plug points and 100 different plugs and with no common. So we spend a lot of time making that, right? So part of effort there is to see can we standardize it? But the proof of the pudding is in adoption. Like UPI really got adopted, getting adopted. That adoption journey is early stages for those two protocols. Good question. All right, sir. Thank you so much. We would be around if anyone wants to have a conversation. Thank you so much, my panelists. Great conversation. I learned so much. I hope the audience also learned, took something away from it. Thank you so much.
Thank you so much. That was a very enlightening session indeed. I now request Shumona to present our moderator, Mr. Belgavi, with a memento. I now request Siri to present Mr. Madhav with a memento. I now request Pranjal to present Mr. Gopalan with a memento. I now request Siri to present Mr. Ramdas with a memento. I would like to thank the panelists and moderator, and I would request you to sit among the audience. Also, please pose for a photograph before that. The audience and all the delegates present are to note that we are breaking for tea, which will be right outside this hall. We will assemble here again within 15 minutes. Kindly note, we will all be assembling here within 15 minutes after a short tea break. Thank you.
Hello. People sitting in the back rows, kindly come to the front rows. Welcome back, everyone. I hope the tea break was refreshing. We'll now move to our third keynote address. Before the session begins, may I request Mr. K.V. Srinivasan to take their seat on stage. May I request Mr. Ashish Goel to felicitate Mr. Srinivasan with a bouquet of flowers. May I request Ms. Sugandh Saxena to felicitate Sir. Thank you. Let me briefly introduce our speaker. Mr. K.V. Srinivasan is the Executive Director and CEO of Profectus Capital, an NBFC focused on providing financial solutions to MSMEs in key manufacturing and services sectors. Over a career of more than 3 decades across the BFSI sector, he has held senior positions at ICICI, Citicorp Finance, Reliance Life Insurance, and Reliance Commercial Finance. He serves as a director of the Finance Industry Development Council and is a member of the Banking and Finance Committee of the IMC Chamber of Commerce. Mr. Srinivasan is an alumnus of the Indian Institute of Management, Ahmedabad, and is also a chartered accountant and company secretary. Please join me in welcoming Mr. Srinivasan with a warm round of applause for the keynote address.
Good afternoon, ladies and gentlemen. Thank you very much to the organization, specifically to Ravi sir, for giving me the opportunity to share my thoughts with industrial leaders and innovators in what is, I think, a fairly exciting and most important revolution that's really happening in our country at this moment, especially in the Indian financial sector. I represent Profectus Capital, which is an MSME-focused NBFC, where we lend money to MSMEs and primarily for the growth purposes, for providing growth capital. Our AUM as of 31st of March 2025 was 300,000 crores, and it's been about 7 years since the journey started. So what we do is we have a very sector-specific approach in the sense that there are specific underwriting and credit policies for each sector or each industry that we speak about, and also for each geography, because India is not really one country in a true sense, because it's a multitude of many, many nations. So where every 200 meters the culture changes, the food changes, and the language changes. So you can't really therefore have a Bombay-focused or a one-size-fit-all kind of a credit policy which ignores the cultural factors. So that is what we have tried to do, and we call that as a cluster-based underwriting approach. It's been a great experience so far. While we are here to talk about digital lending, we are not really true digital lender. We are, because we only do secured lending, and for reasons that I'll speak about later, we can only be a phygital lender. So while we do employ a lot of digital technology to underwrite, the final delivery has to be in a physical manner because of the ticket size as well as various other constraints that we face on the property side and stuff like that. So, of course, it becomes, you can't really isolate it from the current digital revolution that's really happening. And therefore, I remain very much part of the thick and thin of the digital lending environment as well. I also represent FIDC as a director, which has now recently been recognized by the Reserve Bank as the first SRO for NBFCs. And it's again an area where there is a significant amount of work that can be done in the area of self-regulation and stuff like that, which can actually take the NBFC industry to the next level. Now, today, the India's financial ecosystem stands at a fairly important inflection point. Now, over the past 1 decade or thereabouts, we have seen an explosion in the fintech or the financial digital revolution. What started with JAM, Jan Dhan Aadhaar Mobile, and then it created a digital identity. It gave access and it propelled financial inclusion. I think that was the first thing that we did, starting from 2013-14 onwards. Now, UPI, which is really taken off fantastically, has really given real-time, low-cost payment system, right, to every citizen. Now, GST, which is again something which happened later, has brought in greater degree of formalization to the Indian economy. Now, today, more and more businesses are coming into the GST framework, and they're seeing the advantage of coming in and becoming part of the formal economy rather than shying away from it as it was in the earlier days. So the tax avoidance has become lesser of a problem, but the advantages of formalizations have actually are now being realized. And up-to-date data in terms of sales turnover and stuff like that also means instant cash or instant loans for MSMEs. And that is where digitalization has really played a significant amount of role. Account aggregators, which is what we spoke about in the previous session, is also something which is really coming of age, which has the impact of democratizing data, making sure that the data is tested and it's more, I would say, reliable than otherwise. Digitalization of EPFO records, which is again a humongous effort that has been undertaken by the government. Corporate affairs database, MCA website. All of this gives a fantastic ability for us to spot the ups and downs which is really happening in a particular entity or in an industry. Now today, for instance, I can figure out whether my impending customer, borrower, is actually doing well or not by simply looking at how many employees for which he is filing the provident fund or is depositing the provident fund. If there has been a decline in that, let's say going from 100 employees to 20 employees, I know there is something wrong. Or if he's generally having too many directors changes or partners changes, I know that there's some problem in the business. So all these things have become a reality today because of the digitalization. So when we talk about digital, it's not just the app-based lending or the credit bureau integration that's coming in, it's a whole ecosystem that's really coming into the picture. Now, with DPDP, which is now being, the announcement for implementation has also been announced, that is really going to again change the entire digital world significantly by making sure that there is our industry also approaches the whole thing with a consent of control over data, usage only for a certain specific purpose, and all of this will build trust in the organizations, right? So when a borrower comes to us or to any of the digital lenders, he should be implicitly in a position to trust the other organization, that my data will not be misused, that I have full protection. So in a way, I would say that, who's responsible for all of this? I think I can very well stand up and say that for us in India, we are blessed because the government has been the single most important digital change agent. I don't think there is any other country that I can think of where the government has played such a huge role in a digital revolution. And what has really happened is that this push has brought in a significant amount of data availability, credibility of the data, transparency and compliance. The payments and lending landscape today are kind of converging together to a very large extent, right? It's not just about giving credit. It is also about empowering the users. It is also about safeguarding the data and enabling intelligent and connected financial journeys, right? When somebody gets into a payment ecosystem, I can actually track what is really happening to his financials. I don't have to wait for an audited balance sheet to come before I actually lend money to the person. So credit itself can get accelerated and move forward, which means greater amount of money in the hands of the entrepreneur, which means much greater amount of ability to expand faster and not wait for 18 months for a bank to give money based upon the last available audited balance sheet. Full financial inclusion definitely remains a little away, but while the journey was started by JAM, especially the Jandhan part, I think financial inclusion is something that the digital lenders can actually play a huge role, because inclusion is not just opening a current account or a savings account. It is the entire gamut of financial services, including insurance and loans and all of that, that the digital lending platform and the players can play a huge role in it. The current state is as follows, where the three pillars of digital, which is primarily digital payments, digital lending, and digital public infrastructure, are kind of converging today into a certain amount of interoperable, trust-based system. UPI clearly continues to scale up with phenomenal growth. I mean, today we talk about billions and billions of transactions happening every month. And we are also going from being an Indian system to a foreign system, right? We are also exporting UPI to Singapore and to Middle East and so on and so forth to start with. But I think UPI has got the ability to dominate and rule the world if you are able to do it well. But UPI, therefore, has been, in the past 10 years, has grown primarily on the basis of volumes. But today, we are actually looking at not just volumes and growth and pace, but trust and efficiency actually coming into the picture as well. The other part where digital is playing a huge role, and it is started in the consumer side, the MSME side still needs to catch up a lot, is on the embedded financing. Today, when I book a ticket on, let's say, yatra.com, and when I try to pay, I get asked a question, do you want to convert this into an EMI-based payment? I mean, that is nothing but an example of embedded finance. Now, can we do the same thing to an MSME kind of a loan? So based upon his GST filings, if somebody can throw up this question that, hey, you're going at 20% per year, can I give you a working capital loan, or can I give you a supply chain financing? I mean, that sort of embedded financing is the next step, I would say, which will propel the MSMEs growing forward. The biggest problem that any MSME faces today, if you ask anyone, he'll tell you that availability of finance in the right time. It's not the pricing that is important, it is the availability at the right time. Now, if we can therefore put money in the hands of the entrepreneur who's struggling and struggling and struggling to stay afloat, that can actually propel him to grow forward and go from a micro to a small to a medium to a large enterprise. Can we do that? The other ecosystem, like the account aggregator, which we spoke about, is also becoming a backbone of a consent-based driven data mobility. Data is mobile, it is available to everyone, it can be used for a particular purpose, and the authenticity of data is so important, right? And it becomes available to everybody in the same manner that it really deserves to be given. And what is the result of all of this? The ultimate customer delight would be that if I can customize a particular product only to suit that particular individual, as much personalization as we can do, that is where the real customer delight would come in, right? But my circumstances are different from yours. So one size fit all loan offering, or for that matter, any other financial offering doesn't really work. So can we really create a very, very individual, personalized kind of an experience? The AA can actually, and AI put together, can actually do this quite a lot. Now, we have come a significant way from nothing to a very, very large digital area right now, right? Our infrastructure is fantastic, our systems are thriving. But what got us here will not take us to any further extent. What is really required is more than growth. It requires responsible, privacy-first kind of an innovation. And this is where I think that DPDP actually comes in and plays a huge role in it. Over the past few years, look, the market has grown significantly, right, because of digitalization. Now, every growth brings in its own perils as well, right? To give you a simple example, if I talk about the BNPL loans, buy now, pay later kind of loans, while it has made everybody, have access to loans to fulfill their dreams, it has also meant a certain amount of irresponsible borrowing. It has also meant higher amount of NPAs, right? So therefore, just mere growth also has got its own problems. So now is where the time to come back and say, hey, let's do this in a more organized way, in a better manner, so that it becomes more sustainable. So access to easier loans, whether it is for consumption or small businesses, has increased significantly, right? And definitely it's so important from a financial inclusion perspective. But we should also be mindful of the fact that some irresponsible borrower can end up damaging his or her own credit track record. So therefore, a lot of advisory needs to come into the place. Guardrails need to be put into place so that even by mistake, people don't really go off track. Sometimes the problem gets aggravated because of virtually impossible end-use monitoring. Okay, I say that I borrow money for, let's say, putting money into working capital. But if the end-use monitoring is not good, that money could very well get diverted into the F&O segment in the stock market, and I would find it impossible in a downtrend in the stock market to pay back my loan. So better end-use monitoring is an area where digital certainly can play a big role, which I don't see at this moment really happening much. Unless and until the entity which is lending takes huge amount of pains to go and do proper end-use monitoring, sometimes it becomes really very difficult to monitor all these fund diversions. So, I've seen so many cases where a particular hospital, for instance, in one of those very hot markets for F&O operations, 100-bed hospital running beautifully, patients full, 80% occupancy, has no money to pay, simply because the money which was taken to build the hospital infrastructure was diverted into F&O and it never came back. So the guy is over-leveraged. So good business going bad because of non-end-use monitoring. The other one, which I think a way forward is something that we can actually look at. Digital lending has primarily remained focused upon the small ticket lending and unsecured lending. Right? Primarily because one of the reasons that, we do only secured lending. And the one problem that you face is that how do I take care of the property records? Each state is in its own state of development. Some states are very backward in terms of property records. In some states are fairly well evolved. So how do I know that my property that is being pledged to me is actually mortgageable, actually belongs to the borrower? It is not some fraudulent document that is there with me. These are all issues which I face where the digital journey is actually not complete. So therefore, it becomes a very physical effort, which takes enormous amount of time, cost, and effort to actually assess the doability of a particular loan. This is something where, of course, the governments need to actually put in their heads together in terms of digitalization of the property record and stuff like that. And if that gets done, the digital lending can transcend from unsecured to secured as well. Huge amount of AI usage is coming into the picture now. Some of those models are untested, but over a period of time with greater amount of data being available, they will become more and more robust. So AI would actually enhance the portfolio quality significantly, better behavioral analysis, better collection monitoring, better ability to predict delinquencies is something that actually do a huge amount of work, actually help the digital lendings significantly. So unless and until you're able to better predict the customer behavior and go and do active, proactive collection, you would have probably lost the plot. Somebody going after the borrower becomes 30 plus in terms of delinquency, finds it more difficult to recover the money than somebody who goes on day one when there is a problem, right? It becomes so important. The other area that is done extremely well, I think over the past 15, 20 years, which was nothing there in let's say the early 2000s, is the credit bureau. The 4 credit bureaus that we have today have almost perfect information in terms of the consumer lending and their track records and stuff like that. They have focused primarily on the borrowing part. But for a long time, they have been speaking about including behavior on payment of utility bills, for instance. Non-financial data also to come into the credit bureau, which will give a much greater amount of early warning. So if somebody fails to pay his electricity bill, or somebody doesn't, for his factory, maybe there is a problem with the factory. So this could actually get triggered and flagged off much earlier than actually waiting for this CIBIL record to actually go down. So early warnings is something that the digital network can actually do a lot more. National Loan Register is the other thing that the Reserve Bank has been talking about. This would again give a huge amount of impetus once it is done to the lenders to actually look into the picture and say how much is the leverage of a particular borrower, and depend upon that assess his ability to pay a particular loan. To summarize, end-use monitoring, asset record digitalization, authentic repository of loan liability, and predictive collection behaviors. These are 4 things that the digital network can actually do a lot more in order to make sure that the digital lending actually goes the full distance. Enhancement of CRILIC, CKYC, this is the other area which definitely requires a lot of work. The biggest pain point that any bank or NBFC faces is the KYC. Now, work on that has been done, significant amount of work has been done by the RBI on this, with the CKYC coming to the picture, but still a lot more distance still needs to be taken so that duplication is avoided. Ease of taking loans becomes a very important thing. As I mentioned to you, working capital and stuff like that, which are based upon GST data, which is a huge boost to the MSMEs. That is something that is also coming up. A lot of fintech players are actually looking at that as an input for lending as well. Now, one of the things that I really like is the way the RBI has worked on the entire digital lending ecosystem. They came with digital guidelines to separate out the role of a fintech, which actually does a certain part of the job, and also said that no unregulated entity should actually lend out of their balance sheet. So they have clearly delineated information processing and lending in a manner that it is controlled and there is no kind of commingling of risks and responsibilities. So this really ensures that the customer interest is well protected and there is a certain amount of transparency in the entire digital lending mechanism. Separation of roles and responsibilities definitely ensures that the pricing policies are also open and therefore are customer friendly in the process, and therefore there is no predatory pricing or usurious pricing which is really involved. So it's an ecosystem which is really fast evolving. No regulator, however proactive it can be, would be able to stay ahead of it. So regulations are always, they end up being a catch-up game. Now, how do we really solve this? This is where I think the role of an SROs become really important, because I don't see any regulation being better than self-regulation. If the SROs can evolve to a certain level, whether it is FACE or FIDC or anywhere else, in a state there where they are actually coming in even before the RBI needs to step in and take care of the small little issues that the industry is facing, I think this can actually become a wonderful bridge between the regulator and the regulated. And that is an area that I would really be watching out for the next 8 to 10 years' time. Frankly, to end with some amount of good things that DPDP has really brought across. 4 things basically. Express user consent. Number 2, data minimization. That means you only take what is required. Don't take too much data and then misuse it later. The third one is purpose limitation. If you use it for a particular purpose, then the data gets purged. And the last one is accountability through governance. So these are the 4 things that the DPDP itself has been focusing upon. And we will have to obviously wait and see how the implementation goes through. But the thought process is absolutely in the right state. So in a way, I would say that this can lead to a huge leap in the way the customer perceives the digital lending ecosystem. Today, there is a fair amount of suspicion, but that suspicion can actually get removed and the whole system can become a lot more thriving. Finally, I would say that, fintechs can actually differentiate by making consent in a very simple, transparent, multilingual and revocable manner. The entire piece of consent management itself is a huge business opportunity running into thousands of crores. Anybody who takes the initiative in this and becomes the first mover will have a huge advantage in terms of grabbing market share. The second one that gets enabled by a DPDP is and fintech is thin file underwriting through AA, account aggregators, right? Small businesses, gig workers who just don't get assessed in the right way, and new to credit customers. They all can actually get in access to the financial system. So AI plus AA plus DPDP, it means intelligent, responsible credit. What it does is it unlocks faster loan approvals, error-free risk models, low NPA, and better customer experience. So all of this, when I see the situation from a bird's eye view perspective, I say holds a lot of promise as far as the way the directionally India is going. And I would say that it's now to us to participate in this and make India the most vibrant fintech and digital lending economy. Thank you so much.
Thank you, sir, for the insightful address. May I please request Ms. Sugandh Saxena to present memento to Srinivasan, sir? Thank you so much. And as we now shift gears, it's time for our valedictory address on the future of fintech, innovation versus regulation, moving in tandem. I would like to call Mr. Shuvendu Pati to address us. I would like to request Mr. Goyal to felicitate Mr. Pati. Thank you, sir. We are truly privileged to have with us Shri Shuvendu Pati, Chief General Manager of the FinTech Department at the Reserve Bank of India, the person leading some of the most exciting and transformative work happening in India's financial system today. He heads RBI's initiatives on the central bank digital currency, the regulatory approach for fintechs, the regulatory sandbox and hackathons, and cutting-edge projects involving AI, quantum technology, RegTech, and SoupTech. He also oversees open finance initiatives like the Account Aggregator framework and the Reserve Bank Innovation Hub. With 29 years at the RBI across supervision, currency management, foreign exchange, rural credit, and even serving on the boards of commercial banks, he brings unmatched depth and experience to the conversation. He has also represented India on global platforms, including the Financial Stability Board. With an MBA, an MS in finance, and a specialized degree in financial regulation from the UK, he brings both academic and practical excellence. Ladies and gentlemen, please join me in welcoming Shri Shuvendu Pati for the valedictory address.
Is there a caller mic available? Caller mic? No. Can I get a... So good evening, everyone, and it's really a pleasure to be here amongst all of you, and special thanks to the Gokhale Institute, Professor Dr. Ravi Mishra and Sri Das for the invite and having me here. It's always a pleasure to connect with the fintech industry and students at the same time. It's a unique platform in that sense. And Pune is one of the large fintech centers of our country. And the topic or the theme that is chosen today is extremely relevant and extremely, it's close to my personal heart because of two things. In India, when we talk about fintechs, everyone talks about payments ecosystem, and UPI dominates the discussion. And clearly, that has been a sort of a fairy tale story to tell when you see nearly half of India's, the world's real-time digital transactions taking place in India. And in a month-on-month basis, UPI is clocking around 20 billion transactions, and every day around 65 crores of transactions. So the volume is really staggering, and that's a success story. But as the previous speaker alluded to, the no amount of this volume or scale would not have been possible without the having the
First place, people open their bank accounts. And that was driven by the Jandhan, the digital identity before that, the Aadhaar, and the mobile rates, which are so very affordable in India. Even if you have technology, for example, Mexico, the other day the delegates had come, they have everything. They have more mobile phones than the population. But the internet data rates are so high, there is low adoption. So it's a confluence of many things. And one of the approaches that has stood India well is the combination approach of the digital public infrastructure getting created by the public authorities, and those are made available for the fintechs and the innovators to exploit and come up with beautiful products. And this is typically the model that has served us well, and we are seeing no reason why we should not continue with that path. And for example, there is also always a debate. The BHIM app was, it's not where it should be, when it started. But, I would like to pause and sort of ask all of you, was it a desirable thing to build BHIM app at that point of time? Probably yes, there is merit, because it showed people how to connect two accounts. And then people innovated on top of that and build better products. Now probably it doesn't look that, but at that stage when it started, there had to be some authority who need to demonstrate, yes, this can be done this way. So what I was saying, sometimes, even though the innovations fail or did not succeed to that extent, they should not be seen in isolation. It has to be seen in the context of the role that they had to play at that point in time. And therefore, in a sense, at some point of time, they had a role to play and then move on and leave the space open for innovators and private players to come forward and build. So coming back to today's discussion, while a lot of innovation has happened on payments, we strongly feel for a nation like India, there are huge unmet credit needs. As per some estimates, there are around 30 lakh crore, which is the unmet credit need. And of course, institutes like this would be, pioneering research. What would be the real unmet credit needs of people? So therefore, clearly to my mind, we need innovation in the lending ecosystem. And that should be a priority. And therefore, the theme is very apt. Nowadays, really, can we separate, banks or banking or financial services from technology? Absolutely not. So both are sort of intertwined and, inseparable in a sense. All offerings or product delivery or service delivery is digital. And that is the way it is going forward, and it will go forward. So the entire journey, starting from customer onboarding till the collections, till everything, entire thing would get digital as we progress. And therefore, to innovate on the lending is the need of the hour. We have done probably enough on the payments and other side, but this is a critical piece which needs attention. And what it brings, why we need to innovate, because our vision at Reserve Bank of India on lending is that we should be making credit available to the people or businesses when they want, in the manner that they want, and in the quantum that they want. That's the vision we have. And in this direction, we have initiated several steps over a period of time. But as I say, it requires more to be done, more than this hall even. Not a room for improvement, it's a hall for improvement. And there is a lot of space for everyone to play. So in that direction, we have initiated, a lot of projects or initiatives. One of them is on the lines of UPI, which became a household name. We started something called the Public Tech Platform for the Frictionless Credit, which now it has renamed as the Unified Lending Interface. And that is not a very rocket science, so to say. What we are trying to do out there is to bring the data service providers on one side and the lenders connect with the lenders on the other side. And so basically for lending, whatever data sources are required, they need to be made available to the lenders to make a decision on entirely digitally as far as possible. Now there are, as I speak, I can say with confidence and with this thing that we have, lenders have lent about 2.2 lakh crores through this platform. There are about 59 lenders which are onboarded. There are around 12 distinct loan journeys which are live on the platform. There are more than 135 services, including sub-services, which are available on the platform. And more are getting added as we speak. For example, people talked about already the GSTN data is integrated, whatever is available already to the account aggregator ecosystem, but we have already received in principle approval from the GSTN Council to integrate or get more sets of GSTN data which will help lenders in evaluating MSME businesses. We are also in talks with Ministry of Corporate Affairs to get a direct API of their corporate data, MCA database, balance sheets and other details. We are also going to integrate with the income tax database, CBDT database, which will offer you direct insights into the income tax filings. Of course, all of this in a very consented, purpose-driven, purpose-based consent-based architecture. We are also in talks with the Ministry of Road Transport to get the vehicles data, new car for the car financing. DigiLocker is already integrated where all the data which is already available on the DigiLocker is automatically getting available on the Unified Lending Interface platform. And DigiLocker has given us complete assurance that you tell us the data, we'll get you that data on the DigiLocker. So all data is getting unlocked and we are going to see I would say now if the flight is on a taxiing stage, we are going to soon witness the takeoff. And takeoff would be really, really fast and accelerated. I would urge all the fintechs and what it solves for the both sides. For lenders, it obviates the need of bespoke bilateral integrations. Multiple, very complex, it has to one lender has to integrate with 50 lenders, 50 information service providers. Similarly, a fintech has to individually integrate with multiple lenders. And lenders would not trust fintechs. Fintechs would find it difficult to approach the lenders. And this platform would solve that information asymmetry and give the comfort to the both sides. And in terms of volumes, if you are getting a fintech is getting a volume through individually integrating, it would also get the volume here by directly getting on the day one access to 59 lenders, if they all agree. So to my mind, it's a win-win situation from an ecosystem point of view. And it is a game changer. And as our top management are convinced and keep saying, this is going to be this is the new DPI in the lending ecosystem, digital public infrastructure, which we are creating, which should serve the lending ecosystem, which is very much needed. It affords the banks to improve access, reach the unserved segments in a digital manner. Their agents and VCs can go and approach the farmers and landowners. And just to give you an illustration for availing a Kisan credit card loan, the farmer is there. He earlier now takes 3 to 4 days to 4 weeks to get his loan sanctioned because he has to visit at least 3-4 times to the branch. Now you imagine a tablet BC agent or a bank agent goes and serves on reaches him and gets the, just asks two things. One is the identity Aadhaar number and the Khasra and Khata number. Through the direct integration of the land records, the land record is fetched through an API. Based on the NABARD's scale of finance, which is pre-programmed, the scale of finance is decided. And after a credit bureau check, whether he has defaulted earlier, a digitally loan is getting sanctioned, disbursed within 5 to 6 minutes. 1 lakh such loans have already been sanctioned by few lenders across 8 states. More is on the anvil. So this is just a snippet of what is possible. Similarly, Gujarat's Amul Dairy ERP data, milk pouring data. A farmer is pouring 300 days out of 365 days, every day 5 liters. The lenders can do a cash flow based on the specific gravity of the milk that is being poured. This is the quality of the milk, multiply that with the applicable rates, you get a yearly cash flow. So instead of verifying the milk cow in the farmer's yard, they now have a digital data to underwrite how much loan to be given. So this is again getting unlocked in Avin in Tamil Nadu. Amul already is there. There are a few other dairies. But as my previous speaker said and fully endorsed, my mantra, my advice, my suggestion to all the agencies involved are that digitize whatever you can. Then they make themselves amenable to technological interventions. Let's say state registration, stamp duty. These would offer a very good data. But a lot of good work has been done, but more needs to be done on that side. And one of the, moving on to other segments, for example, on innovation facilitation. I would like to say that we at Reserve Bank of India, one of our key mandates is to foster innovation. And in this, we have, first of all, a dedicated fintech department was created. And we have been engaging with the fintechs over the last couple of years. And I am happy to report that we have structured engagements with fintechs every month. And we have done so far 16 or 17 engagements and covered around 1,500 people as part of this. So there are 3 things that we do. One is themed as FinQuery and Finteract, where people can, join in virtually or hybrid manner, seek clarifications, offer their suggestions, and it's a two-way process. Ideas for innovations get generated, what are the current frictions, and we also get suggestions from them. What improvements are required in some regulatory stance on what we need to do more. Then we have, I would say that all of you may not be aware, we have operationalized a framework called the Regulatory Sandbox since 2019. And we have completed around 5 cohorts of that. There are 38 entities who have tested their products seeking regulatory relaxations, and out of that, I am happy to again report that around 15 products are already deployed in the market. And these are getting scaled. So what we do, another initiative that we do and provide a platform to the fintechs is that they require 2 things. One, who will buy their products or services? These are largely the banks or NBFCs. So there is an event that we organize called FinConnect. And the idea is that those entities who have tested in our regulatory sandbox or the hackathons, they get connected or get access to the decision-making authorities across banks and NBFCs directly. That happens on the day 1 when there is a demo day. They pitch their products to and solutions to the users, expected or users. Typical refrain from the banks or the fintechs is that they don't get access to the bank's top management or decision-making authorities. It takes about 6 months' time to reach. So we try to step in and bridge that gap when in a single platform they will get. And on a single day, there were 120 one-to-one interactions after the initial rounds. and some have, success or partnerships have fructified and grown beyond that. Second day, we do connect them with the potential investors, the PE funds and others. So they need money and capital. So this is what we are doing as part of, and it will going to be an ongoing exercise. And third thing, there is a lot of talk. Some people say that people come to RBI, and some people urge that we need to get licensed by RBI. But I would say that at this stage, whatever large number of diverse fintechs are there, and we are of a strong belief or view that we need to create and preserve the creativeness and the innovation potential of the fintech ecosystem. And to do that, we need not subject them or stifle them with onerous regulations. We need to keep them free, we need to keep them agile, and we need to be light touch in our approach. And therefore, we have consciously decided that a self-regulatory approach would be the best way to serve at this stage. And as part of that endeavor, we had come out with a discussion paper, and based on the feedback from the industry, we had finalized that discussion paper, and we had invited applications, and one organization has already been recognized as the SRO for fintechs. What are the expectations from fintechs, SROs? They need to, as a previous speaker also alluded to, they need to form or take care of the baseline standards, formulate the governance codes, formulate the baseline ethics, standardize the cyber security guidelines, because these are all fintechs, they use technology in a big way. So these are the nudges, and also provide guidance on, let's say, now the DPDP Act. So very early stage, small fintechs, they lack resources and the skills to formulate these kind of practices on their own. So it is the role of the SRO not only to find what wrong practices they are doing and sort of correct them early on, but also to guide them and coach them to adopt good practices, and also do a capacity building initiatives. So some of these activities where we see FACE getting associated with this are part of such initiatives probably, which are also a need of the hour. Through Reserve Bank Innovation Hub, we undertake several projects, and other than the projects, we have a continuous engagement with the startup ecosystem. That is called the acceleration and incubation stage. So they are also engaging with a large number of fintechs, running into hundreds, where they provide the insights as to how to set up a company, how to go about product planning, and knowledge partnerships, all those things. So it's a continuous engagement, and as I said, there is a lot more that needs to be done. Individual large institutions also do that, and they are free to do that. And from the ecosystem point of view, we are also lending our bit on that. And I would look forward that now the regulatory sandbox, we have made it on tap, so that anyone can apply at any point of time. So once you meet those basic criteria, you can apply any point of time. Another area that I would like to move on, previous speaker was suggesting that there is no visibility with regard to how the money is getting used, end use of money. Now, I don't know how many of you are keeping track on this, but I would say that when everything is getting digitized, why our poor currency note in our wallet should not get digitized? So we have done that also. So that is the central bank digital currency. And apart from it being a digital form of your same old currency, we have now added the programmability feature to the currency. So that, because it is in a token structure, it has multiple powers and multiple use cases that gets unlocked. Let me share a few examples. And these are real life already implemented. In Andhra Pradesh, there is this Deepam scheme. And what happens there, the government of Andhra Pradesh provides the LPG subsidy, 885 rupees to the households. And out of that, right now the current model was that this amount was getting transferred to the bank account. But whether there was no means of checking whether this money was spent on buying gas cylinders. So what has been done is this money has been credited to the beneficiaries through a CBDC wallet. And program has been written that this can be used within a 3 months period, and this money can be encashed at the LPG vendor or supplier who is authorized. So you imagine the LPG vendor sends a person, the beneficiary books a gas cylinder. So the LPG vendor comes with a gas cylinder, also with a mobile with a QR code. And this QR code that presents to the beneficiary, and the beneficiary will already the wallet is pre-funded. And that scan, when she scans, this money gets redeemed, goes to the vendor. If another QR code, like any UPI QR code, they want to encash, it will not work. So this already 4,000 beneficiaries have already benefited in the pilot in Andhra Pradesh. So what it empowers, and if the money is not used in 3 months, it goes back to the government. Another case I will say. So here is a case of end-use monitoring. Pokra scheme in Maharashtra, this very state. Program on climate resistant agriculture, which is being piloted by the Agriculture Department in Government of Maharashtra. And as part of this, they provide a subsidy to the farmers who buy drip irrigation systems. And the subsidy, let's say, is to the quantum of 1 lakh rupees. But there are many farmers who are not able to give that 1 lakh rupees upfront because they don't have that much money. So they are not able to buy. Only the well-off farmers are able to get that drip irrigation system, of which 80% subsidy is given by the State Department. But that is afterwards. It's a back-ended subsidy. But through the use of central bank digital currency, we have flipped this back-ended subsidy to a front-ended subsidy and enabled those farmers who do not have that wherewithal to provide upfront 1 lakh to avail the drip irrigation systems. Now, how this has been operationalized, let me just give you an example. The money which is being provided by the Pokra scheme is credited to the wallet of the equipment supplier. He gets the money in his wallet, but he cannot spend because the tokenized money is in a locked state. He gets the comfort that I will get this money from the government. So he supplies this equipment. Farmer comes, takes this drip irrigation equipment of worth 1 lakh, goes back to his field, implements or installs those equipments. Then State Agriculture Department, an officer goes and verifies whether actually he has implemented. Now after verification and measurement, he sees that, okay, 85,000 worth of equipment has been installed. So he certifies and uploads a certificate on the Pokra portal that 85,000 worth of equipment has been installed. Now 80% of that eligible amount gets unlocked for the supplier. This is a two-level, double-level programmability which is making possible. So these are real cases. I am not telling stories. And recently, Honorable Prime Minister has announced 2 use cases in Uttarakhand, Project Kiwi and Project Apple, where similar double-level programmability is being used. And in all DBT schemes, this is again, there are, you can now program money on 4 parameters: the BPA level, merchant category code, expiry date, and geolocation. You can spend this money within 5 kilometers. You can use this money only at this specific BPA. So this is already happening. And on the user level programmability also, now you want to send money to your son or daughter, and you don't want him to or her to spend, she can spend anywhere except, let's say, buy alcohol or buy gaming. That also negative listing can be possible. Now you imagine you are taking money out of your wallet, one 500 rupee note, you said, your maidservant is asking you, my son is sick, I want to need some help, give me 5,000 advance for medical treatment or grant. You are not sure initially when you don't have the comfort whether she will take this money, her husband will go and buy liquor. But now you can program that money that she can spend only in pharmacy or buying books in your own wallet. So a lot of possibilities are getting, and what I am saying is these are all innovations which are taking place as I speak. And it's real. I know it's already delayed. I'll just conclude on a few things. Bank fintech partnership. I have a few, I don't know, there are no banks or NBFCs out here. I think NBFCs are here, but not banks. There is always this apprehension from fintech side and bank side, two-way conversation. Banks say that, no, we cannot, they put out very stringent criteria that for onboarding fintechs. Because they're saying, no, we are exposing our systems, CBS to them, how they will treat and whether they are good enough. So the trust factor is missing. Similarly, when fintechs say, no, banks are very high-handed, they are bureaucratic, by the time they onboard, it's ages, time, lot of time is gone. So there is this conflict. But ideally, what we should see, we would like to see them, are that they are not actually competitors. They are complementarities. The fintechs are specialized, they can build innovative products, are agile, can deliver faster, and banks have the solidity and robustness of balance sheet and customer base, as well as enjoy a good degree of trust. And so there is a healthy marriage that can take place between the two. And as you say, there is, in order to, and how does the regulation come into play? If you need to drive fast, what first you need to have? You should check your brakes, whether it's working right. So Regulation Act also acts like a brake. You need good guardrails if you need to grow fast, if you need to drive fast, if you need to accelerate. You need strong guardrails. And therefore, regulation should not be seen something as a stifling factor. It should be seen as a necessity which will enable you to grow faster, drive faster. And therefore, this healthy balance is always necessary. And over a period of time, as both the industries mature, this will take place. I know, moving on to, no discussion or conference these days is complete without talking about artificial intelligence. So like every food needs some salt, small amount, so every conference needs AI. So I would also talk about AI, and I have huge expectations from, see, this is a new technology. Is this a very new technology? No? Okay. You're right. This is not a very new technology. Probably Professor Alan Turing, he said, can machines think? That's when it started, and John McAfee gave its name, and we are here today. But what fundamentally has changed over a period of time is two things come to my mind. Is that we have generated a lot of data, digital data, which has made amenable, which acts as a raw material for AI models to be developed. And second thing what has happened is we have, huge computing power which has come in the way, which are helping build models, solve those things better. Of course, there are API technologies and other things technological. The way the data is handled, that is also very critical. But to my mind, these two things have played a role. But this all said and done, this is a technology which has immense potential, but also poses a multitude of risks. Like I say always, technology should not be seen as an end in itself. It should solve something. So all technologies are good or bad in their own way. It's the way we use that matters. For India, I would say that we have the tech talent, we have the power to really use and innovate using this technology. And that is why we also, from a financial sector perspective, we had set up a committee on, which is called the Free AI. And the report has been released on August 13th. And we had come out with 7 guiding principles or sutras. The report is available on our website. You can, take a look. And I am happy to report that on 5th of November, the government of India, MeitY, announced the AI governance policy. And it is available on that website as well. And they have completely adopted those 7 principles which our committee had recommended as the India's governance, AI governance principles. And they have made a mention of the committee's recommendations. But there are, while these are, good things to go, but I would like to see how AI is used in furthering lending. Can AI enable inclusion? Can we bring new to credit customers because AI would use a powerful tool to analyze alternate sources of data, build credit models which traditional models are not able to cater to. Second dimension, I would like, how do we integrate AI with DPI? So DPI means, let's say, UPI. Can we add AI layer? Already some experiments have happened. Can we bring conversational banking? There are, while we are going digitizing, there is a challenge that we are creating a digital divide. There are people who are not English speaking, people who can't read or write, people who cannot hear or see. They are getting deprived in some sense from this digital revolution. And already Supreme Court has started asking, and probably there is a guideline which says no app can be released unless they meet these guidelines for which support disabled people. Second, we have a large language diversity across India. So can we generate models or can we generate systems using AI which would support regional conversation? People are very comfortable on WhatsApp to record a voice message and send. But there are also challenges. Deep fakes can come. In video KYC, there could be a deepfake. In audio banking, there could be a sound spoofing. So while technology offers a large amount of solutions, it also brings in new elements of threats and risks. So like the Sholay ka dialogue hai, loha lohe ko kaatta hai. So I am sure that AI itself will generate solutions for those kind of problems as well. But it's a time game. Bad actors have nothing to lose. They will keep trying with, automating attacks and other things. By the time a regulated entity comes up with a solution, it will have to do a UAT testing and then release. So ultimately I feel we will come up with the real solutions that meets these risks, but it's a catch-up game. So I would like to see that AI is used in a responsible manner, which improves inclusion, which improves accessibility, which gets us more assistive technology to offer the digital solutions to the underserved or underprivileged. That is something we should keep in mind, and this is my urge to the fintechs, that it's no longer going to be a sort of add-on thing. It's going to be a mandatory thing to do going forward. And all these converge. The first principle that we have laid out in our committee report is building trust. If people are going to continue the digital journey, they need to continue trust the digital ecosystem. Frauds, transaction failures, these undermine trust. So therefore, we must, and be it AI, blockchain or quantum, whatever technology it may be, how powerful technology it may be, it will not be adopted unless it enhances public trust. So foundational principle, everyone who is a model developer or a deployer of the technology or a user of the technology, we must keep in mind that it must enhance trust. And I would like to end on this note, and very optimistic and sanguine note, that we are witnessing some of the early signs of indigenous models getting developed. And also through, Bhashini and other programs which are getting generated, language getting used in a big way. So we would see some action, but as I keep saying, a lot of action is waiting to happen. It will get unlocked as we go down this route. So the message is that clearly we must continue to innovate, choose our space for innovation carefully, and also continue our path of responsible innovation, innovation with a purpose. And in this, we are happy to partner with the entire fintech ecosystem, academia. Please do write to us, approach us, and do some experiment, study, joint study, workshops, and also partner on the sandbox framework if you need any regulatory relaxation. For example, video KYC is a big ask. So we would invite all technology solutions which should give us the comfort that the video KYC process is foolproof, that technology itself can detect defects in an effective manner, which a human in the loop cannot do. So these are the things we would look forward to. We know there is a lot of frictions, for business KYC onboarding. That is another area we would like to experiment also. We would also like to experiment on the NRI's onboarding. That is again a huge friction area. So a lot of areas are there already. And people are, if you see our hackathon announced on our website, first problem statement I have created is think about a tokenized KYC, which is user-held model. We are paying, the first prize is 40 lakhs. So you have still time till month end to submit your proposals. Tokenized KYC. Second, we are talking about offline CBDC solutions. So that is again another problem statement. And third one is, of course, a customer interface. How do you make customer interface more safe? Do look at those problem statements and offer your solutions. We look forward to innovative ideas which go up to a proof of concept stage. Those who are shortlisted, they will be also given a assistance of 5 lakhs for the development stage, even though they are not finally the winners. Second runner-up with prize is 20 lakhs. So we are there for all supporting innovation, and it's not that we are innovating ourselves also. If you have heard about, it's not about regulator giving the guideline and sitting tight. We have built our own model of mulehunter.ai, which is detecting the mule bank accounts. It's already implemented across 23 banks, getting implemented in more banks. So this is something which is showing encouraging results. Already around 1.5 lakh mule accounts have been detected through using this mulehunter.ai. And vis-a-vis the rule-based models which were traditionally employed by the banks, which had efficiency of 20 to 30%, this is going to the accuracy level of 85 to 90%. So this is something we have built ourselves, tested in through an on-prem deployment across 23 banks, and it has been now sort of taken by most of the banks as the default mule detection exercise. And we are building a digital intelligence public platform which should also generate a risk score on the go as transaction level. That's the next step. So a lot of innovations are happening, so keep watching the space, and I know already I have detained all of you. So any questions I'd be happy to take, or any suggestions you want to offer, but do write to us at cgmfintech@rbi.org.in. Thank you very much for the opportunity, and great connecting with all of you.
Thank you so much, sir. Your insights have truly added depth to today's discussion. May I please request Ms. Sugandh Saxena to present the memento to sir.
Account aggregator along with ULI being propagated.
See, there are already 7 account aggregators who are already integrated to the ULI. So they would continue to, provide their services, and the banks are free to, receive information through them. And we don't see this as a, competing element in that sense. So account aggregators would have, each prospective borrower or a client would have multiple accounts, and all account aggregators are not integrated with others at this point in time. So it would need the services of probably a set of account aggregators to do that. But there are works which are also undergoing without the ULI side to bring about some degree of either technical or business interoperability across account aggregators. And, within the 4 walls, and if there are journalist colleagues are there, not to take note, there are, significant customer improvement standards are being brought in the account aggregator framework, which is going to be a big customer initiative. But we don't see, as far as ULI is concerned, now the CIC's Experian is already integrated on the ULI. and I expect other CICs also to get integrated, so that the idea is that ULI should provide a 360-degree one-stop solution for all lending decisions which are non-corporate or non-big ticket loans. So typically, definitely I would urge that below 10 lakhs, where there is no collateral is required, ULI should be the default gateway for all lending. That's our vision. Not for the high ticket corporate loans, but you would be happy to note that using some of the property search companies like Teal and Prop AI, there are a few lenders which have lent housing loans on ULI as well. So a lot of things are possible, but as I keep saying, there is not a room, there is a hall for improvement. Thank you.
Sir, having gone through the free AI report by RBI as well as the AI guidelines by MeitY, I wanted to ask you, the free AI report is more innovation pro, and the guidelines are a bit more risk mitigation. It's more emphasizing on that.
Which guidelines you're talking?
The AI governance guidelines by the Ministry of Information Technology. So what do you think is better in the long run for us as an economy? Like, do you recommend on us being more focused on innovation, or should we be more regulation?
I'm glad that you asked that question. This is again not an institutional view, my personal view, because I have been part of the committee myself. See, if we need to truly capture the potential of a technology, we need to innovate. And therefore, if you look at the third sutra that we have recommended, innovation over restraint. Because when we interacted as part of the initial survey, we covered around more than 90% of the asset size of the financial sector. We got in touch with virtually all the entities, had 1 hour interface with more than 70 entities, how they are using, what are the current frictions in adopting AI. So we could clearly gauge a sense of apprehension among them. So traditionally, even now, despite the nudge, when my internal auditor or statutory auditor or RBI inspection team comes, if they find a mistake, what will happen? That is the fundamental question underlying. Why this needs to be addressed? Because all said and done, AI is a probabilistic system. It's a non-deterministic model. So there are bound to be mistakes. Now our effort is to make those errors or mistakes as minimum as possible. But there are going to be some false positives. So whether the accuracy level is 95%, there are going to be those 5 mistakes or wrong decisions. So how do we handle that? Therefore, we have recommended, and we would still like to go with a pro-innovation approach. So as if you have seen, this recommendation has 6 pillars, and 3 pillars on the innovation side and 3 pillars on the risk mitigation side. And it beautifully balanced on its own. There are 13 recommendations supporting innovation and exactly 13 recommendations supporting risk mitigation. So I would say that while the nudge is definitely towards pro-innovation, and unlike in the previous reports like the EU Act, which is absolutely risk-focused and there is a sense of fear when we approach AI, we wanted to give a very, very different touch to the entire framework. And we wanted, unless you try out, you would not understand, you would not realize the potential. So if you don't try and if you don't fail, how do you innovate? One of the critical pillars or the fundamentals of that is you need to fail. You can fail. So give the comfort, the entities that yes, if you fail, it's not a mistake, it's not an error, it's not a judgment on your quality, endeavor or anything. So we have even gone to the extent of saying, let's say there is a first mistake, something happens. model throws a wrong credit decision. So should the entity get punished on the first instance of the mistake? Our stance is that the first instance should be tolerated. A more tolerant supervisory framework needs to be put in place so that they are not scared to try this technology. Otherwise, no one will try. Then where is the output? Where is the benefit? If the fear mongering is the spirit, it will never get adopted, it will never get scaled, it will never get used. All that it will remain is on a chatbot, customer interface. How much balance in your account? Yes, it will tell. But is that the potential that you want to use? We need to go beyond. That's why the positive nudge. But yes, there would be apprehensions, and the industry as well as the technology entities as well as the deployers, they need to mature. And we need to come out with a different set of liability framework. So in case something goes wrong, whether it is the model developer who should be held accountable, a third-party supplier who has given to a RE, or the RE regulated entity which is deploying this, they should be accountable, or the customer because he has used it in a wrong way. There are three dimensions typically. We are saying at no point customers should be harmed. So even if a wrong decision has been taken, somebody has lost some money, it is the RE's responsibility to compensate. Now it is for the RE to take a responsibility as to depending on the service legal agreement with its own partners, tech partners. But it has to, the buck has to stop with the regulated entity who is deploying, because at the point of deployment, they need to do a life cycle testing of the model. There has to be an element of testing which should get brought into the product approval process. Typically now the credit risk, market risk and operational risk teams assess the product approval process. There has to be an element of AI risk evaluation. If there is a model degradation and model drift, it has to undergo a periodic testing. The auditors of the bank needs also to be trained how to test and audit AI systems. We have also talked about what we say that, developing an AI toolkit, which would test for algorithmic bias, which will test for hallucination. So those kind of toolkits need to be developed as an industry level. And to my mind, SROs can play a good role for that. So a lot of things, red teaming exercises that we have recommended. Red teaming means red team and blue team, they fight, keep on testing the intrusion in the system. So how robust it is. And if we are also talked about how, let's say the BCP, if an AI system fails, is the bank in a position to provide service to the customer or the completely stops? It cannot happen that because one AI system has been developed rogue, you completely shut down that service and no alternate service mechanism is available. So it's a very complex way of handling things. But I would say that we would still go with the pro-innovation approach. Thank you.
Thank you so much, sir. As we come to the close of this insightful seminar, I now invite Professor K.S. Hari, Dean of Research at Gokhale Institute, to deliver the vote of thanks.
Good evening, and it has been a very productive, intellectually vibrant day for all of us here. And it has been a practice for the Institute to engage with the industry, academia, and policymakers. And we always ensure this forum to have a discussion on the various challenges the economy has been facing over a period of time. From the time immemorial, in the sense we have been here since the 1930s, and we are proud to be saying that we have been in the process of these kind of discussions, especially with the financial sector, even way back to the bank nationalization, because I do read that some of the documents that some of the studies done in this very institute has initiated the process for the nationalization of the bank very long back. So that has been the continuous relationship that Gokhale Institute has been with the financial sector. And as we students of economics, we all know that innovation is going to be the driver of future growth for any economy. Earlier it used to be accumulate, accumulate and grow in the capitalist format, but now it has been to be innovate, innovate, and then only we have to grow the economy. So we have been there with that challenge, and at the outset I would like to appreciate my colleague, senior colleague, Dr. Rabi Misra for arranging such a wonderful day for this engagement, and on behalf of the institute and on behalf of all of you, I would request all of you to give a big hand to Professor Misra for arranging this event. And he made it a point that he has been very inclusive in inviting the speakers as well, in the sense that he could immediately collaborate with the, I could see this fintech association, they could come forward with a collaboration, as well as these Fibes, they could come with the support for this day's event. I would like to express the sincere gratitude and thanks to the organizers of the office bearers of those organizations for supporting in this event and being a proactive partner throughout the discussion. And another is the regulatory agency. Of course, we have two eminent personalities from the Reserve Bank of India coming here. We just heard from Mr. Suvendu Padi, who is the head of the fintech division of the RBI. And we could start in the morning with Mr. Vaibhav from the regulatory division of the RBI. And on behalf of the institute, as well as from the RBI chair unit of the Gokhale Institute, I would like to express a deep sense of gratitude and thanks to you, sir, for traveling all the way and being with us and giving such a detailed explanation of the various activities that RBI is undertaking with regard to this thing. So thank you, sir, once again. And I would like to thank the keynote speakers, Vaibhav, Mr. Srinivas, and of course, Mr. Ashish, who has been a great support for this event throughout, and all other dignitaries who were part of the panel discussions. We had 3 panel discussions of 12 participants were there. So all the speakers on behalf of the institute and on my personal behalf, as well as the RBI chair unit, I would like to express my gratitude. And of course, this has been a effort by the RBI chair unit for more than a month. I personally know the effort that has been put forward by the research assistants, research associates, and other people who are associated with the RBI chair unit, as well as with the institute, who has been supporting Misra ji in initiating this kind of a event. So I would like to express our sincere thanks to all the students who were also part of this event, all the non-teaching staff, all my fellow colleague teachers who has taken the time to be here throughout the day. So I would like to express my sincere gratitude to all of you. So this is not the end of the discussions, I'm sure, and this will always open the, because we always keep an open door policy at this institute, So all the fintech entrepreneurs, all the policymakers, all others who are part of this discussion, you are always welcome back to the institute for further discussions, further engagement with the faculty, as well as with the students. We are always open for the dialogues. So any opportunities with future engagement, we are always open for that. And once again, thank you all for being with us today and for having such a wonderful, productive day in our academic life. Thank you.
From regulation to innovation, from rails to risks, and yes, from lunch to evening coffee, we've traveled through quite a landscape today. A heartfelt thank you to all our speakers, panelists, faculty members, students, organizers, and every guest who added spirit and curiosity to today's conversations. This is Rajan, signing off as your host for the day. Thank you for being such an incredible audience.